Okay, so what are we told? What are we told? That is the question number 2. So the question is, Lock Limited, a public limited entity, acquired 80% equity shareholding in Paper Limited, another public limited entity, on 1st of April 2024. So then we are told that the acquisition consideration comprised of an immediate cash payment of 2,400 million made on 1st of April 2024, and a further consideration of 1,331 million deferred until 1st of April 2026. This is what we refer to as the deferred what? Consideration. And then you're told no accounting entries have been made in respect of the deferred cash consideration. Lock Limited has a cost of capital of 10 percent. And then you're told on 1st of October 2024, Lock Limited, together with another entity, entered into a joint arrangement to jointly control Scissors Limited, a public limited entity, public limited entity. Effectively, Rock Limited purchased 50% of the equity shares of Scissors Limited for an immediate cash payment of 1,500 million. The following financial statements relate to the group of companies. So we are given the statement of profit or loss, basically for 3 companies, Rock, Paper, and
given our
Scissors.
colleagues
We have the statement of financial position for the 3 companies. That is Rock, Paper, and Scissors.
Now
and then we have some
we are
additional
supposed to
information.
proceed.
This was actually one of the simplest questions, which has been tested
as we
in advanced
continue.
level
for the sake of time,
So we're given additional
just to
information.
proceed.
You can see actually the additional information.
I believe everybody is ready. Confirm if you can see my notes on the screen.
Then what are we required to do?
Confirm if you can be able to see my notes on the screen.
Consolidated statement of profit or loss for the year which ended 31st of March 2025. The consolidated statement of financial.
Are you able to see my notes on the
position as at the same date. Now, before we do that, automatically this is a question for group accounting.
I've
First
seen
thing we need to do is we come up with a group structure.
Zipporah,
we know the relationship, the nature of investment by the parent company. In the other companies, we go through the additional information as we do the, first, maybe we do any working which
I must apologize
necessary. So we go
thank you
to
for giving me on Thursday. I was not feeling so well.
And basically the first
stability of the project using the net present value method. So we are told to evaluate the project using the net present value method. So it's a lot of information. It's a lot of information that should not confuse you. A lot of information that should not cause confusion. What you're supposed to do, it is to follow. It is to follow. Just follow what the question says. So let's start with the workings. Let's start with the workings. So the first one, we'll start with the initial costs. We will start with the initial cost of the project. So let's have initial cost here. Initial cost, we are told fixed capital investment of shillings 4 million. Capital investment. Capital investment. The capital investment is 4 million. 4 million. Capital investment. Then you have number 2. The initial investment in net working capital is 400,000. Working capital is 400. And this will give us 4,400. Then we have note number 2. The initial investment in net working capital is shillings 400,000. The body is not clear. Oh, so what is the problem now? So just a minute. So let's give it a few minutes, probably it will be okay. Yeah, let's just give it a few minutes. I know it will stabilize. It will stabilize. In the meantime, kindly just let's bear with it. Let's bear with it. It will stabilize. Hope you can be able to see something. I don't know. You're struggling. So we hope you can't see anything. Hey, how bad is it? Let me check. Let me check. Okay, we already have the initial cost. We have the initial cost. So let's continue. So next, we compute what? We compute, no, we were on note number 2. We were on note number 2. We're saying the initial investment in net working capital is shillings 400,000. At the end of each year, net working capital must be increased so that the cumulative investment in net working capital is 1/6 of the next year projected sales. So let's start with the sales. Let's start with sales. Let's start with sales. We start with sales. Year 1. So which statement talks about sales? Note number 3 says the fixed capital, no, not that one. There is that statement which talks about sales. Which is it? Which one is it? Number 4, sales are shillings 2.4 million in year 1. Year 1, it's 2.4 million. Sales are 2.4 million in year 1. Then they grow at 25% rate for the next 2 years. Year 2, sales will grow at 25%. So 125% times 2.4 million times 2.4 million. How much are you getting? 125% times 2.4 million. $3 million, eh? So 3 million. Then year 3, they will also grow at the same rate. They grow at 25% annual rate for the next 2 years. So 2 years. $125% times 3 million times 3 million. 3750,000. Year 4, they are saying for the last 3 years, sales will grow at 10%. Next 2 years and then grow at 10%. So 110% times 3750 times 3750. 10% of 3750. $41.25. 4125,000. Year 5, 110 times 4125,000. And then year 6, 110 times whatever you're getting here. 4537. This is 4537. 500. Then here 4537 500. You'll get 49.91 to 50. How many nines are these? No, 40. So it should be 991 to 50. Is it? Yeah, that's okay. That's okay. Now, so we can now compute the working capital, because you're told working capital must be a third. The question says in note number 2, let's go back to note number 2. In note number 2, the question says at the end of each year, net working capital must be increased so that the cumulative investment in net working capital is 1/6 of the next year projected sales. 1/6. So, okay, fine. Let's have the sales here first. We have year 1, 2, 3, 4, 5, and 6. 5 and 6. We have sales. Sales year 1, it's 2.4. Here it's 3 million. Here it's 3750. Here it's 4125. Here it's 40. Hey, there is a 0.5. This is 4537.5. And this is 4991.25. Those are the sales. Let's leave working capital first. Let's do away with working capital first. Let's go to note number. Also skip note number 3. Let's go to note number what? Note number 4 we've dealt with. We've handled note number 4. Annual rate for the last 3 years, yeah. Number 5, fixed cash operating expenses are 300 for year 1 to 3 and 260 for year 4 to 6. 6, variable cash operating expenses are 40% of sales in year 1, 39% of sales in year 2, 38% of sales in year 3 to 6. So variable cost, let's have variable cost, variable cash operating expenses, variable expenses. Variable expenses, we're saying 40% of sales in year one. So 40% of this is how much? $960, yeah? So 960 here. Here it's year two, it's 39%. 39% of sales in year two. 39% of sales in year two. 1170. Then from year three, and 38% of sales in year 3 to 6. 38% in year 3 to 6. 3750. This is 1425. Then 4125. 1567.5. Next. 4537.5. 1724.25. And the last one, 499.125. 1896. I don't know whether you can see that corner. Okay, yes. 1896. Point 68. That is variable expenses. Next, let's have the fixed cash operating expenses. Fixed costs, fixed cash operating expenses. Fixed expenses, they are saying fixed cash operating expenses are 300,000 for year 1 to 3, 300,000. 300,000. 300,000. 300,000 for year 1 to year 3. Then what else? And 260 for year 4 to 6. 260. 260. 260. So then we will have earnings before depreciation and tax. Here, what else? Let's check whether there is something that you've not accounted for before that. Corporation tax is number 7. The corporation tax rate is 30%. If taxable income on the project is negative, what? Fixed capital investment will be sold, what? So let's get earnings before depreciation and tax. Earnings before depreciation and tax. Earnings before depreciation and tax. So we are lessing, we are deducting. So the first one, earnings before depreciation and tax for year 1, it's 2,400 minus 960 minus 300. That is 1140. 1140. 1140. Then the other one, 3,000 minus 1170 minus 300. 1530. 1530. 3750 minus 1425 minus 300. It's 2025. 2025. Next, 4125 minus 1567.5 minus 260. 2297.5. Next, 4537.5 minus 1724.25 minus 260. It's 2553.25. And the last one is 4991.25 minus 1896.68 minus 260. The 2834.57. 2834.57. Let us less tax. Yeah, less tax. We are lessing tax at 30%. They are saying tax is 30%, eh? Is it? Yeah, tax is 30%. So 30% of this (0.3 times 1140), 342 times 1530, it's 459 times 2025 times 2025, 607.5 times 2297.5, it's 689.25 times 2553.25, it's 765.98. Then 2834.57 times 0.3, it's 850.37. Add tax shield. Add tax shield. So the tax shield will be on capital allowances. The tax shield will be on capital allowances. So we will rub this part. Let's do away with this part. We already have cells there. So capital allowances. Capital allowances. The question says, note number 3. Note number 3 says, the fixed capital is depreciated on costs at the following rates. So this is it depreciation or capital allowances? Which one is talking about capital allowances? So let's say depreciation. Capital allowances or depreciation? Depreciation. Let's say depreciation. So the fixed capital is depreciated on costs at the following rates: 30% in year 1, 30% times 4 million. Then 35% in year 2. Can you add these percentages and see whether they add up to 100? Add those percentages and check see whether they add up to 100. Okay, fine. So if they add up to 100, that means we are depreciating on straight line. So it's year 2. Year 2, what is the percentage? 35% times 4,000. Year 3 is what? 20% times 4,000. Year 4, it's 10% in year 4. And then year 5. Year 5 is 5% times 4,000. The first one is 1,200, is it? The second one is, this is 8. This is 800. This is 400. This is 200. So 30% times 4,000, 1,200. 1,400 here. 1,400. Then I believe the rest are okay. Tax shield. Tax shield, we say it's depreciation times tax rate. Depreciation times tax rate. So year 1, it's 1,200 times 30%. Year 2 is 1,400 times 30%. Year 3, it's 800 times 30%. Year 4, it's 400 times 30%. And then year 5 is what? 200 times 30%. So the first one is 360. The second one is 420. 420. The third one is 240. This one is 120. And this one is 60. I hope that is okay. So we add 360, 420, 240, 120, 60, and nothing here. 60 and nothing there. So we are not adding, we are not getting the totals. Let's proceed. Let's proceed. What else? Now we can have additional working capital. Additional working capital. Additional working capital. Net working capital. So the question, let's go back now. We want to compute working capital. Which is not number. At the end of each year, net working capital must be increased so that cumulative investment in net working capital is 1/6 of the next year projected sales. Of the next year projected sales. I want to do away with this part kindly. If you can do this so that we proceed, if you can have this first. Or if you're okay, we proceed. We rub. Okay, let's do away with this part. So working capital must be a third of sales. Net working capital. Year one. A third of sales. This is how much? A sixth. So that the cumulative investment in net working capital is 1/6. 1/6. Yeah, 1/6. So 1/6. Then this is 400. Is it? 400. No, not 400. We are saying what we are increasing, it's next year's sales, exactly. Next year's sales. At the end of each year, net working capital must be increased so that the cumulative investment in net working capital is 1/6 of next year projected sales. So 3,000 here, 3,000 here. So this will be 500. 500, but already we have what? Already we have 400. Are we together? So minus 400, we get 100. So here we will increase 100. And it should not be an increase. It's a negative. It's a negative. It's a negative, so less. Less. We are lessing because it's an outflow. It's an outflow of cash. Are we together? Okay. Year two. Year two. 1/6 times. 1/6 times what? 1/6 times 3750. 1/6 times 3750. 625, 625. How much do we have as working capital as at now? It is 500. Remember, we started with 400, we added 100. So in total, we have 500. So we will add what? 125. So here we have 125. 125. Year three is 1/6 times 4125. Is it 4125? So 4125 divided by 6. 687.5. 687.5. Minus 625. Minus 625. year 4. It's 1/6 times 4537.5. 4537.5 year 5, 1/6 times 4991.25. So this is 687.5 minus 625, it's 62.5. Then 1/6, 4537.5 divided by 6 is 756.25 minus 687 minus 687.5. 687.5. It's 68.75. Then the last one, 4991.25 divided by 6, it's 831.88 minus 756.25. 756.25. 75.63. 75.63. So after 125 here it's 62.5. Then here it's 68.75. 75.63. Then year 6. We have nothing for year 6. What does the question say about year 6? There is a statement that talks about year 6. Which statement is that? Note number 8. Note number 8 says, fixed capital investment will be sold for shillings 300,000 when the project is complete, and recapture its cumulative investment in net working capital. And recapture its cumulative investment in net working capital. Income taxes will be paid on any gains on disposal. So we need now to get the total working capital. The total working capital will be recaptured here. So here maybe you can put a dash and say add recovered net working capital. Recovered net working capital. So what is the total amount of working capital that you have invested? It's 831.88. Is it? 831.88. In short, it is 400,000 plus this, plus this, plus this, plus this, plus this. 400,000 plus whatever we've added during the period. Are we together? Let's see whether it's okay. 400 plus 100 plus 125 plus 62.5 plus 68.75 plus 75.63, 831.88. We are together? Now we are remaining with two items. We are remaining with disposal. Disposal. The question says, fixed, note number 8 still, fixed capital investment will be sold for 300,000 when the project is complete. That is salvage value. That is our salvage value. So here say salvage value. Salvage value. Salvage value 300,000. Salvage value of 300,000. Any other thing? There is a statement that talks about gain on disposal, something to do with that. There is a statement that says the corporate tax rate is 30%. If taxable income on the project is negative in any year, the loss will be offset. The loss will offset gains elsewhere in the corporation, resulting in tax savings. Not that one. So which statement talks about capital gains? Okay. Number 8, fixed capital investment will be sold for shillings 300,000 when the project is complete and recapture its cumulative investment in net working capital. Income taxes will be paid on any gains on disposal. Income taxes will be paid on any gains on disposal. Now, do we have gain on disposal or not? Gain on disposal. Gain on disposal. We will have a gain on disposal. At the end of the project's life, net book value will be 0 because the depreciation that we had here, the depreciations that we had, they totaled to 4,000. Are we together? That means at the end of the period, the asset will be fully depreciated. The asset will be fully depreciated at the end of the period. However, it will be sold at 300,000. So gain on disposal, it will be, what do you say? Gain on disposal will be 300,000 minus 0. Because the net book value is 0, this is net book value. This is the proceeds from sale, salvage value. So it will be 300,000. Tax on gain on disposal is equals to 300 times 30%. This must be 90. Is it 90? This should be 90 unless I'm wrong. Is it 90? So that one will be less here. Less tax on disposal, tax on gain on disposal. That will occur in year 6, 90. It's a negative. It's a negative. And that is all what was required. That is, those are the net cash flows now. Net cash flows. Net cash flows. Let's compute the net cash flows. So it's earnings before depreciation and tax minus 342 plus 360 plus 100 or minus 100. That is 1148. Are you getting 1148? And 58. How? 1140 minus 342 plus 360 minus 100. Yeah, 1058. 1058. Next, 1530. 1530 minus 459 plus 420 minus 125. It's 1366. 1366. Then 2025 minus 607.5 plus 240 minus 62.5. It's 1595. 1595. 2297.5 minus 689.25 plus 120 minus 68.75. 1659. 1659.5. Then 2553.25 minus 765.98 plus 60 minus 75.63. I'm getting 1771.64. 1771.64. Then 2034.57 minus 850.37 plus 831.88 plus 300 minus 90. 3026.08. 3026.08. Let's have discount factor here. Present value, interest factor. The cost of capital is 12%. So this one is 0.89. Was it 29? 8929 7972. Yeah, 8929 7972 7972 7118 6355 5674 5674 then 5066. So let's get the present values. Get the present values. You have 1058 times 8929. This is 944.69. Let's have two decimal places. 69 1366 times 7972. 1088 1088.98. Then 1595 times 01118. 1135.32. 1659.5 times the 6355, it's 1054.61. Then 1771.64 times 5674, it's 1005.23. 1005.23. Then 3026.08 5066. 1533.01. Let's get the total present value. NPV is equals to total present value minus initial costs. Minus initial costs. So let's get the total present value. Total present value is the summation of all these. That is 6761.84 minus 4400 minus 4400. $2361.84. $2361.84 is what I'm getting. Kindly check yours. Okay, fine. So that is what was required in that question. 2361 point. Okay, what was the question first? They had said, determine the suitability of the project using the net present value method. Any question? Any question? Any question? So the most important thing I said is to come up with this. Another thing, for examination purposes, there are things which will not trouble you a lot. Just put them. If it sells, put sales. Variable cost, put variable cost. Fixed expenses, put fixed expenses. Get the totals if you have to. Then you tax. So whatever is straight, whatever has been given in the question, like the variable cost and the fixed cost, put them. The salvage values, put them there. What else? Net working capital, put them. Then you leave what is likely to bother you. So these are per entries. The marks are allocated per entries. Like each entry has got a mark. Each entry has got a mark. Yeah, it's not the final answer. Even these workings, if you do them correctly, for example, what needs computation like these ones will have maybe some more marks compared to the fixed expenses, which was being picked direct from the question. Yeah. So whatever is being computed will earn more marks compared to what is provided in the question. Now, so we'll have a small break. Then we look at this question was December 20. We look at August 2022, question 1B. After the break, let's look at August 2022, question 1. August 2022, question 1. After the break. So it's August 2022, question 1B. August 2022, question 1B. So let's again read the question. Dima Limited has developed a new product and is considering whether to put it into production. The following information is available. Development costs will be shillings 4.8 million. 4.8 million is the development cost. Production will require purchase of new machinery at a cost of 2.4 million payable immediately. The machinery has a production life of 4 years and a production capacity of 30,000 units per annum. Production costs per unit with variable material cost 8, variable labor cost 12, variable overheads 12. Fixed production costs, including straight-line depreciation on plant and machinery, will amount to 200,000 per annum. That is fixed production cost, including straight-line depreciation on plant and machinery. 4. Selling price is shillings 80 per unit. Demand is projected at 25,000 per annum. But in note number 2, remember we are told the machine has a production capacity of 30,000 units. But selling price is shillings 80 per unit. Demand is projected at 25,000 units per annum. The retail price index is expected to increase at a rate of 25% per annum over the period, and selling price will increase at the same rate. So selling price will increase at 5%. Annual inflation rates on production costs are as follows. So also variable material cost is 4, variable labor cost is 10, variable overhead is 4, fixed cost is 5. The weighted average cost of capital in nominal terms is 15%. Then required, advise the farm whether to undertake the production using the net present value approach. So let's do that question. The most important thing in this question is the adjustment of the selling price and variable costs to incorporate the inflation rates. So we'll start with year 1 to year 4. We have year 1, 2, 3, and 4. We will start with the selling price. Selling price in year 1, note number. Selling price is 80 per unit. So 80 per unit. However, note number 5. The retail price index is expected to increase at a rate of 5% per annum over the period, and selling price will increase at the same rate. The selling price will increase at 5%. Yeah, at 5%. So let's increase the selling price at 5%. So it's 1.05 times 80. Here it's 84 times 84. 88.2. And the last one, 88.2. 92.61. 92.61. 92.61. Then variable costs. With variable costs, variable material costs, variable material costs. The first one is 8. Variable labor costs. Variable labor costs. Year 1, it's what? So here we are less in 12. This is 12. Then we have variable overheads. Variable overheads, it's 12. Variable overheads is 12. But still, they are changing. So let's increase variable material costs by 4%. Let's increase by 4%. So the first one is we are growing by 4%. So 1.04 times 8, it's 8.32. Mm-hmm. 8.32, 8.65, then 8.65, 8 point, this is 9. I'm getting 9. I don't know what you're getting. Then variable costs, variable labor costs will increase by 10%. 10%. So 13.2. 14.52. 14.52. 15.97. 15.97. Then next, 4%. 12.48. 12.98. 13.50. 13.50. So with that, we can get the contribution margin, contribution per unit, contribution per unit. Contribution margin. Contribution margin. So we start with the first one. So remember we are multiplying now, or rather not multiplying, but we're getting the difference. 80 minus 8 minus 12 minus 12. 48. The first one I'm getting 48. Then 84 minus 8.32 minus 13.2 minus 12.48. 50. Next is 88.2 minus 8.65 minus 14.52 minus 12.98. 52.05. The last one. It must be 4 years. Remember the useful life is 4 years. 92.61 minus 9 minus 15.97 minus 15 minus 13.5. 54.14. Are you getting the same figures? Kindly confirm. Okay. Now the units, production units. So what I was saying is that while the machine has a capacity to produce 30,000 units, the relevant unit is what they can produce and sell. So in this case, note number 4 says selling price is 𝐻𝐿80 per unit. Demand is projected at 25,000 units per annum. 25,000 units. So let's have here sales in units. Sales in units. 25,000. We are multiplying here. We are multiplying to get gross contribution. Gross contribution. Gross contribution is 48,000 times 20. Oh my goodness. 48 times 25,000. 1.2. Let's have the figures in thousands. Let's have 1,200. Let's have 1,200. Let's pick 1,200. Yeah. Let's have the figures in thousands. So that this 25,000 yeah per annum. It's per annum. Then 50. 50 times 25. It's 1,250. It's 1,250. Next is 52.05 times 25. It's 1301.25. 54.14 times 25. It's 1353.5. That is contribution. That is gross contribution. Then we have fixed costs. Where is fixed costs? Number 3. Fixed production costs, including straight line depreciation on plant and machinery, will amount to 200,000 per annum. One of the problem is including straight line depreciation on plant and machinery. Then note number 2 says production will require purchase of new machine at a cost of �2.4 million, payable immediately. The machinery has a production life of 4 years and a production capacity of 30,000 units per annum. They have not told us anything to do with the salvage value of the machine. So, but these fixed costs, it includes depreciation, and depreciation is not tax allowable, or rather it's not a cash item. So what if we say depreciation is equals to 2.4 million minus 0/4. You get how much? That will give us 600,000. Is it 600,000? 600,000. Are you there? So then the fixed production costs, including depreciation, including straight line depreciation on plant and machinery, will amount to 200,000 per annum. So here there is a problem. There is no way depreciation can be included in this fixed cost of 200,000. What may be, do we have salvage value? Just check across whether we have salvage value. We have no salvage value. So some information must be missing. It's either The questions wanted to talk about excluding depreciation, or they forgot to tell us what is the salvage value, because you can see depreciation per annum is 600,000, but the fixed production cost, including the depreciation, is 200,000. So we will just work with the fixed cost of 200,000. Let's ignore issues to do with depreciation. So fixed costs we are lessing. We are lessing 200,000. 200,000. Okay, again, we said when there is no tax. Do you see any point that talks about taxation? The question is not talking. What are you saying, Zipporah? What's your question? Note number 5. The retail price index is expected to increase at a rate of 5% per annum over the period, and selling price will increase at the same rate. Annual inflation rates on production costs. There is an increase by 5%. Thank you for that correction. So the fixed cost will grow. So what, Alan, tell us the amount of depreciation that is included in the fixed cost. That is where we are stuck. Just give us the depreciation figure. So let's grow this by 200,000. So Alan, you're saying, the question says the depreciation is included there, but the depreciation that we are computing here is more than that, the 200,000, which does not make sense. And as a result, we have decided to ignore depreciation and work with the 200,000. So 200, we are growing this by 5%. 210 here, 210, then 210, 220.5, 220.5, 220.5, it's 231.53. Anything else that we've not accounted for? The development cost and whatever. That will be, the development cost will be part of the initial cost. That will be part of the initial cost. So let us get the net cash flows. Let's get the net cash flows. This is 1,000. $1,000. 1,250 minus 210. It's 1040. It's 1040. 1301.25 minus 220.5 is 1080.75. Then 1353.50 minus 231.253. It's 1121.97. Then present value interest factor, we're using 15%. 15%. We are using 15%. So 15%. Remember, these are lump sums, eh? 8696. 8696. 7561. 6575. 6575. 6575. 5718. 5718. Then present value. Present value. For lump sum. Annuities, we say this, it's when the cash flows are similar. And I would want us to have a question for annuities. I don't know whether we will find one. 869.6. 869.6. Next. 1040 times 7516. 786.34. 1080.75 times 6575. 710.59. Then 1121.97 times 5718. 641.54. So let's get the total present value. Total present value. $869.6 plus 786.34 plus 710.59 plus 641.54. Then initial cost. Let's compute the initial cost. Initial costs. So we have the cost of the machine. They are saying what? Development cost will be 4.8. Now note, if this development cost, we are told that it will be incurred. It will be incurred. The question says, where is that question now? Development cost will be shillings 4.8. If the question had said that development cost has already been incurred, or rather, if the question said development cost incurred is 4.8 million, then development cost would not be relevant in this case. We are only considering development cost because it is going to be incurred. It is a futuristic cost. It is not a sunk cost. Do you remember the issues to do with past costs? Yeah, so that is what you're saying. Then number next, production will require purchase of new machinery at a cost of machine. Cost of machinery. It's 2.4. The total initial cost. The total initial cost is 7,200. So NPV is equals to total present value minus initial outlay. So this will be 3008.07 So 4191.93. 4191.93 is the NPV. So the question said, advise the firm whether to undertake the production using the net present value approach. So the question is, okay, not the question, but I suspect this question has got issues. This development cost here, maybe they should have said the development cost has already been incurred. Because if you look at what the question says, they are saying that a product has already been developed. Or rather, where is that question? If you look at what the statement says, they are saying Dima Limited has developed, you see, has developed a new product and is considering whether to put it into production. Has developed. But note number 1 again says, development costs will be shillings 4.8 million. So what I think here, they should have said that the development cost incurred is 4.8 million, such that here we will only have, this would become irrelevant, this would become irrelevant, and then here we would have this, and the NPV would be positive something. The NPV would be positive something. However, we do not make assumptions in exams. Even if you see a question and you feel it might have been different, you just do what? Just use the information as it is provided. However, there is no way they'll say they have developed a product, then they still tell us that the development cost will be shillings 4.8 million. No, that does not make sense. So, but we just use the information as it is. So, any question? Any question? So now this must be enough for capital budgeting, or what do you think? Should we do more questions on this? Or we can look at other areas? Yes? At your own free time, go and try September. It's a very good question. September 2021, question 2B. Very good question for September 2021, question 2B. Any question? Oh, we were supposed to advise these people whether to produce or not. So advice, the firm should not the firm should not undertake the production. The firm should not undertake the production. The firm should not undertake the production since the NPV is negative. Because the NPV is negative, the firm should not undertake the production because the NPV is negative. Now, so you have said you're okay with capital budgeting now. We can go to something else next time. Okay, fine. Let's do cost of capital. Let's do introduction to financing decisions next time. That is on Saturday. Should we meet on Friday? What do you think?
Which approach, Florence? Which approach are you talking about? We have talked about, okay, let me go back so that you understand what I'm saying. So that behavioral management approach is a school of management thought that emphasized on the importance of what? Human behavior. So these people look at how can we change the human behavior to be able to increase productivity. How can we be able to look at the needs of the employees? For example, can we satisfy their needs so that they become very productive? Employees whose needs are satisfied by the company are normally very motivated and very much productive, and also attitude. Can you be able to change the attitude of your employees so that they become what? People who are oriented, or people who are focused on helping the company achieve its own objectives. So basically, this theory is all about look at the human behavior, needs of the employees, and attitudes. So ensure that what? We have a conducive work environment so that the company becomes more productive. Lawrence, are we good now? Are we okay? Good. Now, the first person who supported this behavioral management theory is a researcher by the name Elton Mayo. So Elton Mayo, on his theory, he talked about what? Human relations theory. So in his research, he was looking at what? Human relations and how it can help a company move towards what? Achieving its objective. Now let's look at, so that Elton Mayo was a key figure in the development of human relations movement, which emphasized the social needs of workers and the importance of interpersonal relationship in the workplace. So according to him, he looked at how can we be able to improve the social needs of the employees, and how are we able to improve relationship. There must be a good relationship between the employee themselves and the employees and management. If you are able to emphasize on those relationships, then basically the company will be able to perform better. So he dwelt on look at what? How can we improve the social needs of the worker? Employees need to belong. Employees need to be feel like what? People appreciate them in the company. Employees need to have a support system around them. At the same time, how can we be able to improve the interaction or the relationship among the employees themselves and between the what? Employees and management? Now, in this theory, he came up with some key concepts. Number one is that Mayo conducted the Hawthorne study in the Western Electric Company. He did that in 1924 to 1932. That means it took 6 years in carrying out that research. This is a good researcher. It took a lot of time in trying to what? Trying to carry out this research. Now, which aim to study the effect of physical conditions on productivity. So look at what? How can the physical condition of the company affect productivity of the organization? The results showed that social factors such as what? Feeling valued, that's a social factor, feeling valued, such as feeling valued, feeling valued and being part of the team has greater influence on productivity than what? Than physical condition. If I'm in a place where I feel like my employees, my fellow employees trust me and my manager trust me, then basically I feel motivated to be able to what? Help the company achieve its objective. Now, what were key findings from this theory? When Elton Mayo was doing this research, what was his key findings? What did he find out from this Hawthorne study? So he said that the first thing he found out was called the Hawthorne's effect. Now, what is this thing called the Hawthorne's effect? That workers' performance improved because they knew they were being observed and felt that management cared about them. So employees believe that whatever we are doing being done, when managers are observing what we're doing, then we tend to do work, be motivated to work. At the same time, when managers feel like we are valuable to them, manager values us, managers see value in us. Most of these companies people work for, you find that there's a major term. There's a term that most managers use or most people in authority use, and they tell you that we can without you as an employee. So that means there's no value. They look at you like what? You're a liability. You must know that the employees you have are your first asset. Anybody who is in management here, the people you are leading should look at them like an asset. It's okay, you can fire them and get a new employee, well and good, but what you know to know that what? You will never get an exact employee. You can get a better one or the worst employee than the ones you have. So basically, try to value employees in their own aspect. Now, this second finding is that what? Informal work groups, so that social groups within the workplace strongly influence individual behavior. Now, when we talk about social groups, there's what's called social formations within a work environment. All of us may be working. I'm using may because I don't know exactly. Most of us may be working in organizations, whether private or public institutions. Now, there's what is called social formations within the workplace. There are people that you just feel comfortable around. Nobody told you to be friends with them, but as you continue working, you find that you have the same ideals, you have the same perspective of life. So basically, you tend to gravitate towards one another in the workplace. So when I see Zipporah, let's say when I see Zipporah, I see somebody else. So there's somebody that's very close to you at work environment. And then when you don't come to work, people ask you, where is so-and-so? So basically, when you have a strong social fabric within the company, you're able to what? You're able to behave. If the person you interact with is a top performer, automatically you also what? You improve in performance. That's what he says. Then another key finding was on the employee morale. So that high morale increases productivity, low morale leads to what? Underperformance. So if you're able to boost the employee morale, just encourage them, let them know that you value what they're doing. Let them know that what they're trying the best for the company. When you boost employees' morale, basically, they become very productive. So that's what happens. So as a manager, find ways in which what you can be able to boost employees' morale. Some people believe that the morale or the motivation of employees is only via money. There are some what's called what? Non-monetary motivation. Recognition that somebody is not good. So basically, find some non-monetary means to be able to what? To be able to motivate employees. Don't just believe that it's only money. Employees, when you give them money. Money is one of the major motivation factor, but basically, there are other ways you can use to what? Manage employees so that what you're able to improve their performance. Very important. Now, what is the implication of this 𝐻𝐿ton-Mayo or human relation theory as per the 𝐻𝐿ton-Mayo? What is the implication of this theory? How does it help organization, or what is the implication of this theory? So we see that what managers should focus on employee welfare. Ensure that the welfare of your employee is taken care of. Managers should focus on the employee welfare, talk about remuneration, talk about work environment, ensure that your employees are working in a good work environment. The welfare of employees should be given priority. So welfare, communication, ensure that you're able to what? Pass information as and when needed so that employees don't get wrong information. And also what? Group dynamics. You must know how to manage groups. You must, anytime we are in a company is a social setting. So there's bound to be these groupings. How do you manage these groups? You must know who is the most influential in that group. That's what, if you want to bring an issue, you will bring issue through them. That's what happens. You need to know your employees, which of your employees has more power than the rest, who can influence who. So basically look at that. Then the second implication is that encourage participation and teamwork to boost productivity and satisfaction. Ensure that employees work as a team, not as individuals. Ensure that you create teamwork. When you create teamwork, employees will become. So for example, in a department, every member of the department should work to ensure that then we achieve what's called what? Departmental objective. Those who don't work as a team, sometimes you may be a very good employee in a given company, but you tend to be so individualistic. You can be fired, however good you are, because sometimes we need what's called what? Collective work. We need everybody else to be bottom. So if you're somebody who try to just divide the group, or you want to be seen as you are the most performing employee, you don't want to lift others, and sometimes for the sake of the company harmony, you may be let go and you wonder now, this was one of our best employees. Why did he go? Because there's an aspect of what? He's not working with the rest. He's not a team player. He's good individually, but now there's some jobs that requires what? Requires a departmental effort. So if you are somebody who wants to do things separately, then basically sometimes you may feel like what, or you may hinder what's called the overall goal of the company. So basically, that's what 𝐻𝐿ton-Mayo did. He did a research, and these were his findings. We talked about the findings, and also we look at implication. How can this theory help us to ensure that what we manage now? So if you decide that I want to apply 𝐻𝐿ton-Mayo or human relations theory, then you know what he did, what he found, and how you're able to what motivate the employees to be able to what perform better. Now, on the 𝐻𝐿ton-Mayo or human relations theory, are we good? Mwalimu, it's another point here. Florence, I think I'm moving at a very slow speed now. I'm moving at a very slow speed, Florence. I'm too fast. Hey, let me ask the rest. What do you think about my speed? Maybe I need to get a second opinion. Yes, if all of you say that I'm too fast. Okay. Mutie is also saying that I'm very fast. So Florence and Mutie are saying that I'm too fast. The rest are saying that we are poor. So what? I think this theory I've taken too much time to explain, but there's no problem. We'll go. We'll try. Let me repeat on this theory so that at least everybody is at par. But at the same time, we must know that we have. This is a professional course. It has got like I think this one should be having like around 11, 12 topics. So we also need to what balance. We'll balance the speed at the same time. Try to ensure that there's understanding. So I'll try to understand. I understand you, Florence. I understand what you're saying. I understand what. We'll see. We'll see. Okay. Maybe Florence. Do you have the notes that I've shared? I've shared the notes in the group. Maybe you don't have the notes. Do you have the notes? I'd share the notes in the group. So you're still making other notes? What you do, okay, this is just a suggestion, Florence. If you're able to print the notes, if you're able to print them, understand the situation. If you're able to print the notes, then you can be making short notes on the notes that you have, so that you have the hard copy. You are reading the hard copy that you have at the same time. Make notes on that hard copy so that we are able to move on well. But I understand your fear that this is a receipt and you want to understand maximally, which is okay. But at the same time, we'll try to find a balance in which we move at a good speed. At the same time, we try to cover the syllabus. So I'll try to find a balance. I understand, Florence. I understand what your point, but also if I go slow and then we finish at topic 5, the semester end when you're topic 5, basically, so I'll try to become moderately slow so that at least you understand at the same time we cover the syllabus. Because if I don't finish the syllabus also, it acquire another problem. So we need to balance. We need to balance. To cover syllabus pia na pia speed yetu ikuwe ile ya understand. So let us all try to balance. But here, Florence, have you been in this class last time? Were you here last time? Oh, you are in RCM, yes, understand. But I can tell you that those who were here last time, all of them passed the exam. Because we revised more than 10 papers. We finished the syllabus and revised more than 10, not one. To revise, we revised the CPA past papers of PPM from around 2020, tukamaliza, tukaingia ya CS. Because CS also has got what? A principle of management. CPA has condition management, but the same thing. So we revised like 10 papers. Tulimaliza ya CPA, tukaenda mpaka ya CS from around 2020. So we'll do that so that ukienda kwa mtihani utakuwa sawa. That's why we are trying to what? Balance. Balance. So Florence, in case you need any assistance also, just inbox me. Inbox, then basically you can be able to what? Help. So we are here for everybody else. So kila mtu anatoka paka mbita. Last time tulikuwa na 100% pass. If you believe I'm lying, ask anybody. You can ask Mr. Kiana or Mr. Dongo, atakwambia hapa nangangana to ensure that what everybody pass. So that on so we revised more than 10 papers last time, I can assure you, and everybody came up. And then somebody also came from another college here who was also very much afraid. Like in today, we ensure that everybody pass. So we'll balance that one, understand. So let me repeat it for the sake of us having harmony. Let me repeat this one once. So let's look at 𝐻𝐿ton-Mayo's human relation theory. So this guy called 𝐻𝐿ton-Mayo did a research to be able to what? To look at, say that he did a research on the aspect of what? Social needs of workers and importance of what? Interpersonal. Means what? So that if you're able to meet the social needs of workers at the same time, ensure that there's a good relationship between or among the employees, then basically you are able to ensure that what? We become very productive. So I'll be reading and then I explain. That's why I'm highlighting. So that 𝐻𝐿ton-Mayo was a key figure in the development of human relations movement, which emphasized the social needs. So he emphasized the social needs of workers and the importance of what? Interpersonal relationships in the workplace. So he said what? If you're able to meet the social needs of workers, at the same time, improve how they interact, then basically, as a company, you're able to will perform better. Now, what were the key concepts in this theory? Now, we have two key concepts. Number one is that Mayo conducted the Hawthorne study. So his research was the topic of research was called what? Hawthorne's study on a Western electric company. He did research in 1924 to 1932. Now, which aimed to study the effect of what? Physical conditions on productivity. So that what? If you're able to improve physical conditions of the company, then we'll be able to what? As a company, we'll be able to what? Be more productive. That was his first concept. Number two, the results showed that social factors like feeling valued means if an employee feels like the company values them, feeling valued, and being part of the team, they feel like what? They play a part in the company goals. Being part of the team has a greater influence on productivity than physical conditions. Physical condition is, for example, giving an employee like a modern laptop or a good laptop, having a good office environment. Is that what? The social needs of the employees, if you're able to take care of the social needs of the employees become very productive as opposed to what? These aesthetics of the office looking good, the desk and all those things. So employees are social beings. So taking care of their social needs will make them more productive. Now, from these studies, what were his findings? The findings here that what? His findings were, number one, it emphasized on the Hawthorne's effect. Now, what is this Hawthorne's effect? So that workers' performance improved because they knew they were being observed and felt that management cared about them. So when you are observing employees in doing their work, if there's something that is something that makes them uncomfortable as a manager, you identify and then correct it. So that's number one. Number two is second findings was what? On the informal work groups. So social groups within the workplace strongly influence individual behavior. What are the social groups in your place of work? How can they help you to improve? So basically, the people you surround yourself with are able to make you more productive or less productive. Then number three, it talks about his finding was what? Employee morale. So high morale increases productivity, low morale leads to what? Underperformance. So if you're able to improve the morale of your employees become more productive. But if their morale depends or goes down, then that employee will never be productive. Now, This theory, how can this theory now help us? We talk about implication for management. What? How does this theory help us in managing? Now you're a manager. If you read about 𝐿𝐿 human theory, how can you apply it? Or what can you do to ensure that what? Your employee perform better? Number one is what? Managers should focus on employee welfare. Things like employee well-being. Things like issue of what? Talk about payments. Talk about the issue like how ensure that employees have got maybe insurance cover, health insurance cover, so that if they have a sick relative or a sick child, basically they are not disturbed financially. So ensure that they feel comfortable. Communication, always pass information, whether feedback, whether good or bad, ensure that employees get feedback. And then also group dynamic, ensure that what? You have a good formal grouping that is able to what? Help employees work better. Now, the second important is that encourage participation and teamwork to boost productivity. Ensure that each and every employee participates. There's nobody without any idea. We normally say that word. Sometimes when you're in a meeting, ensure that each and every employee bring their idea, whether good or bad. It depends that that idea can be reformed, or this that can what can be refined to become a good idea. Always give your opinion. So those are what 𝐿𝐿 found out. I don't know if that was now understood. Or is it understood now? On 𝐿𝐿, are we good? Good. Then let's go to the second theory here. The second theory is on somebody called Abraham Maslow. Just 1 minute, please. Now, the second theory is on Abraham Maslow. So this other theory is on Abraham Maslow. There's somebody called Abraham Maslow who is also did research on how to be able to motivate employees. So Abraham Maslow basically categorized needs. So let's look at the overview of what this thing called Abraham Maslow. So Abraham Maslow developed a theory of human motivation. So when Abraham Maslow was doing his research, he was looking at what? Human motivation based on the hierarchy of 5 needs that influence behavior and performance. So Abraham Maslow, what he did, before I explain the notes, Abraham Maslow came up with 5 classes of needs. And he said that an employee, the needs can be classified into 5. And he said that once a need has been satisfied, it is not a motivator anymore. That's what he said. For example, he said the first needs are called what? Physiological needs. There's food, water, and shelter. Once an employee has been able to get food, shelter, and water, food does not motivate them anymore. You have to move to the second category of needs. That's what he did. Now let's go one by one. Say that Abraham Maslow developed a theory of human motivation based on hierarchy of 5 needs that influence behavior. Means what? He was able to classify them as the first, second, third. He ranked them. That's what it's called a hierarchy. Hierarchy means what? From lower to, so there are lower level needs and there are higher level needs. So that's what Abraham Maslow needs. So his 5 levels of needs include, number 1 is physiological needs, which are also called what? Basic needs. Physiological needs, which are also called basic. So basic needs such as what? Food, water, and shelter. So his first category of need at the bottom of the pyramid is called what? Is called physiological. So means what? the first thing you need to give an employee, you must ensure that what employee has got food, has water, and shelter. That's the first thing that motivates employees. Now, once those physiological needs are satisfied, you cannot motivate employee by providing food and water again. Now you have to go to what? The second category of needs, which is called what? Safety needs. Now this one said that what? Employees need security, and security here we talk about two. Number one is protection from harm. Employees need to be able to know that where we are working, we are protected. That is protection from harm. We are in a safe and secure work environment. At the same time, there's what's called what? Job security. We need also to ensure that what? Our employees feel like they are in a stable employment. Anytime you're given a 6-month contract, a 1-year contract, you are not very comfortable because you ask yourself, what if the contract ends? What happens to me? People who are in permanent employment, their mind is settled because they know that what? I'll do this work until I retire. So that's what so they say that what? Once you meet the basic need, now go to safety needs. Can you ensure that your employee feels secure where they're working at the same time? They have a job security. So job security motivates employees. Then once you fill the safety needs, you have to move to the next level of needs, which is called what? The social needs. This one are needs that what? Employees are social beings. So basically, they want to feel a sense of belonging. Does this company value me? And that's why sometimes you find that even at workplace, people start forming issues like chama. Those ones are basically, we want to ensure that what? Our social needs are taken care of. We interact. Those ones are basically, when we talk about what? Issues of social needs. Very, very important that you look at them. Then talk about what? Friendship. Basically, in a work environment, we need to ensure that what? We are not only colleagues, we are also friends. So you need to create an environment where employees feel like what? They are also a family. Apart from being workmates, we should try to ensure that what? We increase it or we make it better so that when I look at a fellow employee, I look at them like what? My brother. So we must create friendship. Apart from professional friendship also, we must have ensure that what? We go beyond what? The social circles. So that's on what? Friendship and also love. People need to be appreciated. The employees, sometimes you see some companies at the end of the year, they take people out, maybe for vacations, they give people vouchers. Those ones make them feel what? Loved and appreciated by what? By the members of the organization. Then once the social needs are taken care of, then we go to the second or the fourth needs, which are called what? Esteem needs. So this one means employees want to feel, these are basically feeling of being in a position of authority. That's what's called esteem needs. So recognition, people recognize your effort. People recognize you are the head of department, you are the manager, you are the head of, so basically those one, recognition, respect. You command respect. People respect what you're doing. So basically that one is another aspect, and also self-esteem. When you are, if for example, in the office, you are given an independent office, you feel very important. You are HOD, you go to work. So basically, those aspects, recognition that you are the head of a department, even your office, sometimes you find that what? They have written something in your office of the HOD. Those ones are aspects of what? Esteem needs. People feel very important. They feel people give them respect. And that's what all call what? Esteem needs. And then the last needs, is called self-actualization. And so this one, very few people reach here. Very few people reach here. This is basically, you talk about, this is where somebody say that what? I've done what God created me to do. I've achieved the highest level that I wanted to achieve as a human being. That is called what? Self-actualization. Realizing one's full potential and self-growth. For example, being a CEO of a given company, being a president, after being a president, in a given country, what do you think? Maybe in that land, you have achieved the highest office. So basically, look at that. So those are called what? Hierarchy. Now, how does this theory help in motivating? So if today is Ipora, Maina, Knox, or any other person here, I employ any of you in my company, I must ask myself, this employee, which level is he in? Is he somebody who's still in the physiological needs or safety needs or social? So that I know what motivates you. Because if I give you a wrong motivation, or I give you a wrong, if I classify you in a wrong group, whatever I may think is going to motivate you will not motivate you anymore. You don't need food. You just need an office to feel motivated. You need to be given what? A position to feel. So basically, any employee that you employ, ask yourself, where are they in this hierarchy? So that when you know where they are, you can now try to provide for them what is next, what is in the next hierarchy for them to feel motivated. But in all these aspects, money is a motivator, whether in the physical needs or safety. As you go up the ladder, money is a uniform motivator in all those levels. I've seen a question here. Yes. What they were doing is, these are basically separate researchers, but they were looking at separate areas. So Mayo was looking at what? How you are able to what? Improve social aspect, or how social aspect improve employees' motivation. But now Maslow was looking at how the needs, or he classified the needs, so that to say that what, for you to motivate an employee, you must know where are you? Are you in the physiological needs level? Are you in the safety needs? Are you in the social? So that what, we know what motivates you. If you have food in your house, good, any food you want, and I come and give you food, food will not motivate you. So I look at what is next. What doesn't this employee have that when I give them, they feel motivated in this job? So this is what Abram. So if you're a manager, given employee, a given company, ask yourself, these employees I have, which is their level of need? Where are they? Now, what can I do to motivate them so that I don't do something that they don't feel is a motivation anymore? Are we together? Up that point, all of you, are we good in whatever I've tried to explain? Yes? Is that point understood? Yes, so Abraham Maslow categorized needs into five. He categorized needs into 5 categories. Yeah, he had 5 categories. Florence and Muti has responded. The rest? Zipporah, Maina, Knox. Are we good? Ismail, yes, we're good. Now, from that explanation, we need to look at the key principle in this theory. What are the key principles that every manager should look like? I'm highlighting in yellow so that you know where we are. I like highlighting, so I'm highlighting in yellow. So we are in where I'm highlighting in yellow. Now, that key principle: needs must be satisfied in a hierarchical order, starting from the most basic. So according to Abraham Maslow, we must be able to what? Satisfy needs in that order, starting from the basic. That means food, clothing, and shelter, which you call what? Physiological needs. Then you move up. That's why you find that sometimes, I don't know if you've seen it. If you walk in the streets of Nairobi and you see these street kids and street families, you see them sleeping in the open, under a tree, under the bridge, or under the in front of the shops, and they sleep very comfortably. Sometimes you even move at around 7, or on weekends when people don't open, some shops don't open, you find them at around 7, they are still asleep. And you ask yourself, how do they feel so comfortable? You see, those kind of people, what matters to them is food. If you're able to give them food, they don't care about any other thing. If your stomach is empty, you don't even think about security, you think about food first. Once you are full, is when you say, kumbe niko mali insecure, niko wapi, because you are full. That's why even sometimes when people get jobs, mtu alikuwa naishi maybe in one of the informal settlements, alafu akapata kazi, you see them wanaanza to move out of the place. Why? Because now they feel like in this place, if I buy my 24-inch TV, I feel insecure here. If I buy, so basically those ones are natural happenings. Even your friends, let me tell you something about even friends. Some of your friends, once they get good jobs, they'll stop being your friends. And don't be offended. Sometimes that is how nature is. So that I knew this guy when he was here, now he's gone to some place, now he's the CEO, he cannot even say hi to me. That is how nature works. A few of them will remember you, some of them may have another social circle. That's how life is. So don't feel offended that somebody was your friend and then now, so yeah, we have gone to some of our friends' offices whereby we are told by security to book what? Come and book appointment. And this somebody I know, my friend, we used to know, we hustled together. Then now, has been told that what? You can only see him on Friday at 2. Now look at that. So basically, those are things that how life is. Then once a lower level need, the second point, once a lower level need is met, the individual seeks to satisfy what? The next level. So needs, that's why you first satisfy the physiological need, then you go to what? Safety needs as you move up. And then number 3 is what? Unsatisfied needs motivates behavior, while satisfied needs do not. So I'm motivated to achieve the needs that I've not yet achieved. Whatever I've achieved will not motivate me anymore. If you finish CPA K, CPA doesn't become about an academic motivator anymore. You look for something else to do. Whatever you've achieved does not motivate you anymore. You want to achieve something new. That's what they're saying. So that unsatisfied needs motivates. You want to do your master's, you want to do your PhD. That one motivates you. You want to do your undergraduate, motivates you. But if you've done a course, it doesn't become a motivator anymore. You want to move up to the next. That's what he's saying there. So once a lower need has been satisfied, it doesn't motivate anymore. So if you have food, if giving you food does not motivate you, no. You need me to what? Give you a position to become now what? Head of section or head of the department. Now, then let's look at implication of this need. What is the implication? For example, if you're a manager, you want to apply this, how can it help you? How can this basically theory help you as a manager? So there's one that I've highlighted in green, we're in there. So one is what? Managers should identify the level of needs their employees are at and create what? Work environment that what? Fulfill those needs. I must know where you are. Are you at the physiological level, safety level of whichever? Then what? I know what to do to motivate you. You may have 3 employees. Each one of them, different things motivates them. And what motivates employee A may not motivate employee B. But what I know is that money is a common motivator, unless somebody convinces me. Even the people in the higher hierarchies still need money. Give them office and money. Make them a CEO and give them more money. They're going to be very satisfied. Then, number 2, provide job security. Ensure that what? Employees feel secure. Job security, team collaboration, recognition, and opportunity for what? Personal growth, enhance employee motivation and performance. So all those aspects talk about job security, collaboration, recognition, and opportunity for what? Personal growth. I must see an opportunity whereby today I'm at lower level. Once I finish my CPM or CPK, I should see how I can be able to move up the ladder or be able to what? Get other chances here. So that is called all on Abraham Maslow hierarchy of needs theory. Are we good on that theory? Is the theory well understood? Is the theory well understood, ladies and gentlemen? Mutie is saying yes. The rest, JK is saying yes. Let's interact. If you have a question, you ask. If you don't have a question, you just say yes, and then we proceed. Because I like being a response, because somebody may be still constructing a question. So if I go ahead, so that's why when you respond by just writing why or yes, we feel good that we are good, then we can proceed. Now, the next theory was done by somebody called McGregor. Now, anytime I read this theory, I wonder, where are Africans here? Africans, when these guys were doing this theory, we are still migrating, or what happens? Was there any African who was able to just sit down and come up with the theory? It's a challenge. We must do theories. Next time, ensure that we'll have a minor theory, an Ishmael theory, or a Zipporah, or maybe what? Florence theory. Ensure that you do something that your theory can be read in books. Now, let's look at McGregor theory X and theory Y. So McGregor classified employees into 2. There's a question by Florence here. Say that, Mwalimu, I have a question. I have 2 employees. One is loved by the people and not productive, while others is not loved and very productive and does her work well. Kati yawa, who should I promote? Florence, professional relationship and personal relationship are different. What at work environment is about productivity, nothing else. Not about being friend, carrying for me tea or doing ABCD. At the work environment is about productivity. If you're my best friend and you're not productive, we drop you like a hot porridge now. There's nothing like being loved. At the work environment is about productivity, nothing else. So if you want to promote the one you don't like but very productive. Because if you're a manager, that employee's productivity contributes to your performance. If you are the head of department, the performance of your juniors determines your performance. So if you put somebody because he's a social friend and then they're not productive, you are also going to fail. So retain the person that is not your friend but very productive, and fire your friend who is not productive. Just tell them that, my friend, you know you're my friend. And I'm going to be honest with you. In the social aspect, you're wonderful. In the professional aspect, you're poor. So let me fire you. We are going to be still friends outside there, but let me retain somebody who's able to what? Help the company achieve its objective. You fire them when smiling. Let them go. If it's about promotion, tell your friend that you make me happy here. You are very social. But you cannot be a head of department if you've not proven yourself that what? You're productive at this lower level. So promote the person doing the job. I don't know if there's anybody agreeing with me. At the job environment, there's nothing like being loved. It's about productivity. Anybody who is supporting my argument? Somebody who is disagreeing with me? Promote the most productive. Leave alone relationships. Those ones are after the office. After passing the gate, your friend. That's how it's supposed to be, Florence. There's something called merit. Let meritocracy prevail. Even if somebody is your brother and they're not productive, fire them today. Go home in the family meeting and support what you did. Some of them may curse you, but in that family meeting, let them know that this was my brother. I love him so much. That's why I did not want to put him in a level of authority because he's going to embarrass himself. That's why I fired him to come home and do farming. And if your family members are people who are good, they want to say that you have done a good job because you didn't embarrass our family by putting him at the helm and then you bring the company down. So sometimes you tell your friends the truth that you're my friend, good socially, we interact a lot, but in terms of productivity, you are letting me down. So in case any promotion comes, basically, that's why sometimes I have a problem with those who mix personal relations with professional. There's also somebody who could be your friend at the same time very productive. That's now a good one. But nobody should not hang on the social interaction or connection to get promotions. That one is a no for me. Even your children, train them to know that things are acquired on merit. So that if you don't acquire it on merit, well and good, but tell them that what? Anything that they get in this world is about productivity. Can you be able to what? Do something of value? That's what it's supposed to be. Good. I think, Florence, you are answered. So, huyo mwingine mwambie tu wewe rafiki yangu, if it comes even to do downsizing, you will go. Wewe utaenda nyumbani tu. You're my friend, but if a chance comes for downsizing that we need to reduce employees, you are going to go. If you don't change, my friend, you will go. And I'll sign your letter, dismissal letter, then I'll wish you well, but we'll still interact outside there. Now, let's look at what McGregor did. So Douglas McGregor proposed two contrasting views about workers, which he called theory X and theory Y. So this McGregor said that in any company, you people are working somewhere, we can group those employees into two categories. We have the theory X employees and theory Y X employees. Now, let's look at theory X. What do you say about theory X, which are called what? We call them, in theory X, if you're a leader, you must go for what's called what? Authoritarian style. If you are managing employee who belongs to theory X, you must be a dictator. These people These ones are people that don't listen. These people don't like work. So if you're going to manage in your company, if you have theory X employees, apply dictatorial what? Management style. So say that word. This theory assumes that workers don't dislike work. They don't like working. They avoid responsibility. They require close provision and are motivated by money and threats. You cannot be a manager who threatens employees if you're not a dictator. So these employees every time tell them that, you know, you will fire you. You are not doing. If you don't do that work by Friday, I'll do a warning letter. So that means what? Because if you look at these guys, number one, they are lazy. They don't like working. They don't like work. Number two, they avoid responsibility. Who is going to do this one? All of them are. They now, everybody disappears. And then they require, if you're not in the office, you see everybody now say that, oh, we are now free today. We'll do work when the manager comes. So number one is what? They require close. If you're not there, if you just jump out for lunch, you find things are in chaos. Then the only motivation they know is what? Money. When they tell them that you want to give them money, now they work very hard. And also threats. Tell you, I don't see you taking 2 months in this company. The way you're behaving, those one now they start behaving. So managers using this approach tend to be controlling and strict. You're very strict. Time. This one, people now you sit down and look at time. So you're very strict on them. So that's called what? Theory X. So in every company, we must have theory X employees. Then we use what's called what? Theory Y. Now theory Y, if you want to manage them, apply what's called what? Participative management style. Now, what are the features of this? Let me use a different color to explain this theory Y. Employees. I'm using. I think that is blue. So theory Y assume that workers are, number one is what? They enjoy work. That means what? Theory X are basically direct opposite of theory Y. These workers, number one, they enjoy work. Number two, are self-motivated and responsible. Means even if you're not there as a manager, these guys will come to work, do their work as if you are there. They are self-motivated and what? Responsible. Number three, they seek opportunity to grow. Means any opportunity they see that can make them grow, they seek it. If about going to school, they go to school. If about going for some seminar training, they seek those. They ask you, sir, can you be able to help me do this one? If they want to go to school, they let you know. So we call them what? We call them, they seek going to grow. Means what? They are always very curious. They want to ensure that what? They grow. And then can be creative and innovative. These guys are very creative. They are very creative. They try to come up with better ways of doing things. They don't want to do things the way the others do. They want to become a better way of doing. So they're very what? They can be very creative and very innovative, these employees. Now, here use what's called what? Participative style. Now, in every employee, in every company we are in, we must find these people. I know even where you're working, there must be these characters here. Actually, this theory X, there's always one person. A company must have a representative of these people in every company, even where you're working. And ask yourself, do also self-assessment. Are you the one? Are you one? You can also be a theory X person as an individual. Do what's called self-assessment. Number one, do you like work or you work? You don't like work. Do you take responsibility or you avoid responsibility? So basically, we have theory X and theory Y in this company. Now, what are the key differences between these theories? What are the major differences, or what are the key differences between these theories? So that theory X sees people as lazy and untrustworthy. So anybody you see an employee, you say these are lazy bones. You cannot trust them, and they require control. Requiring control is what makes them, now you apply what's called what? A dictatorial leadership style. You become a dictator. You must ensure that what? You tell them that what? They have to do things by force. Now, theory X sees people as capable, means people or employees can stand on their own. They see them as capable, employees as capable, and self-directed, means these guys will work whether you're not there. Thriving in environmental of trust. You trust these employees that you can leave for them work to do and go somewhere and come back and find that what? They have done the work in a proper manner, or they have done the work properly. That is on what? On theory Y. Now, what is the implication of this theory? If you're a manager and you read about this theory, how can you apply it? Or what is the implication of this theory? So we are the implication, the one that have been able to highlight in, I've been able to highlight it in what? In blue. No, this is blue. Blue, yes. See that theory, theory Y is more aligned with modern management thinking and encourage employees' involvement, delegation, and development. So in a modern company, you must, or you what? You should have what? Theory Y. A modern employee should be self-motivated, trustworthy, somebody what? Who seeks motivation, seeks what? Responsibility. Now, manager should empower employees. So empower your employees. Ensure that your employees are empowered. Empower your employees. Should empower employees. Provide meaningful work. Ensure that you give them work that basically challenges them, and encourage what? Participative decision making. Ensure that what? Your workers are also they participate in decision making, that or what? In the decision making. So ensure that what? Your workers become part of what? Part of decision making. So involve them. Ensure that you call them. You can be able to what? You can be able to basically involve them in decision making. That is very, very, very important that you look into that. So that is on the McGregor's theory X and theory Y. Any question on McGregor theory X and Y? Any question on McGregor's theory X, theory Y? Any question on McGregor's theory X, theory Y? Yes, we are good. Your theory in Kosawa. All of us have understood the theory well. Then we go to another theory done by, at least now we have gender balance here. There's also a lady who did a very good work and was able to what? Come up with a theory. This is called Mary Parker Fallett's management theory. So there's also a lady who did a very good research and has been able to what? Able to basically come up with a theory that we are now learning. Now we say that Mary Parker Follett is considered a pioneer in the field of organization behavior. Means what? They were the first people. Pioneer means what? They were first people who did research on the area of what? Of organization behavior. They did a research on the area of what? On the area of organization behavior. They did a research on the area of organization behavior. Did a research on that area. So a pioneer means what? They were the first people that did research on that area. The first people that did research on that area. Just a minute. Now, so she emphasized the importance of human interaction. So he said that what? Human interaction is very, very important. So she emphasized on the area of human interaction. Also on the area of collaboration and conflict resolution in management. So he said that number one, you must ensure that what? There's good interaction between or among you. There's collaboration between management and employees and between employees themselves. And there's an amicable way of resolving conflict. Anytime you have a place where there's more than one person, there's bound to be conflicts. Now, he said that what? There must be a better way to what? Resolve conflict. Now, what are the key concepts in his research? So I'm highlighting in yellow, you can see. Number one, the first key concept is said that there's something called power with, not power over. So that if you're a leader, you should work to ensure that what? You cooperate with the juniors you should apply power with, not power over. There's no employee you have power over that have power over you. No, you have authority over them, but not power over the employee. You can only have authority over an employee and not power over them. So you apply what's called what? Power with, so that you work as a team to achieve. So leadership should not leadership should be about cooperation and mutual respect, not control and domination. Respect. However junior an employee is in the workplace, give them the respect they deserve. Don't ever disrespect an employee because of the level they are in. Even somebody who is cleaning your office, even the security guard at the gate, give them due respect. We are all human. And sometimes the position we are holding is out of the privilege and maybe the favor of God. So we should not abuse them by making those who are doing junior or lower jobs feel like they're less of a human being. Because we need them. Imagine a situation whereby you don't have security guards, you don't have cleaners. How will the environment look like? So basically, everybody fits well where they are. So respect their jobs and their responsibilities. So should ensure that there's mutual respect, not control and domination. Number 2, integration. Conflict should be suppressed and compromised. No, conflict should not be suppressed or compromised, but resolved through integration, a win-win solution. So if there's a conflict in a given company, don't cover that conflict. Open it wide, let's discuss and resolve it amicably. Avoid cases whereby any conflict you put them under the carpet. One day it's going to explode. Ensure that what? Every conflict that comes, we open it wide, the parties involved are called, we resolve the conflict amicably, so that when everybody goes home, they know that what? The conflict was resolved. I mean, everybody, when we resolve the conflict, we have what's called what? A win-win situation. Everybody feel like what? They have won. Not a case where somebody feel like what? This thing was resolved and the other party went with what? A bigger percentage of what? Of a win. Then we also talk about number 3, about group influence. So groups and teams are essential for problem solving and decision making. Groups and teams are essential for problem solving and decision. So ensure that what? Every time you do something, involve the group, discuss with people, call meetings, so that you see that what? This was a departmental decision, not an individual decision. So try as much as possible to involve others, so that when people fail, we fail as a team. When people succeed, as a team. But a case where you want to take all credit, then basically you are not a team leader. You are not a team player. You are an individual. That's why even if a company performs better and you're the CEO or if your department performs better, you are the HOD or the CEO, always appreciate the efforts of the juniors in helping you what? Become the best CEO or the best head or the best performing department. Don't take credit for it. Everybody had a contribution to do. Then the last one is leadership. So managers should act as facilitators rather than what? Dictators. Promoting shared goals and participation. As a manager, don't be a dictator. Although in management, you should be able to flip or do what's called what? Keep on changing management style. There are times when you bring a little bit of dictatorship. There are times when you bring collaboration. There are times when you bring participative. There are times when you bring democratic. There are times when you bring laissez-faire, free reign. So basically, as a manager, don't be so predictable. Let your employees start guessing how will you act, and that one puts them on top. But there are cases where people say, so and so has been promoted. We are now free to do whatever we want. So basically, be somebody who tries to make it, you mystify, you make people believe how I want to act. So sometimes just mystify leadership. Sometimes act very weirdly and people believe that, hey, is this really Zipporah we know? There is not, so that people know that there are times when you change how things are supposed to be done. There are times you're very friendly, but there are times when need things to be done, you're also very tough. Tough doesn't mean you're arrogant. Tough means what? You just need things to be done at the right time. And sometimes there's something called, you must be assertive, not rude. Assertive means what? you mean what you say. We say that this thing should be done by Friday at 1. That Friday at 1, I should see it here. If you don't bring it by that time, then basically we need to take what? A disciplinary action against you. So sometimes as employees also, let's not just blame managers. The heat that comes from the top is also very high. And if you're not able to help manager manage it, or help the manager in such a way that they're able to do things the right manner, sometimes those managers the heat will come down. That's what happens. When you see your HOD is putting pressure on you, know that the heat is coming from above. He or she is also finding what? A way to disperse the heat. This is too much. There's a target, the departmental target, there's a branch target, and there's a company target. The CEO wants to see the company target being achieved. They ask the people junior, what are you doing, Bana? We are beyond target. The person also escalate down until the junior most person. So when you see the heat coming from up, means what? Everybody is just trying to trickle it down. So when I'm the HOD and there's a pressure on me, I also put pressure on you. You also put pressure on what? Those who are your juniors. That's how it happens in a company. Those who are in management here know that there are times when the moods in the office are not good. Things are not working. So those ones are some of what. So you must be able to what? Fine. But at the end of the time, you must know that what? You're dealing with human beings. And a human being is the most difficult resource to deal with. We call it human resource. This is the only resource that has a brain that thinks. So dealing with them requires some aspect of what? Intellect. Don't deal with the human beings the way you deal with machines. Human beings are employees who are intelligent. There are people who are intelligent. And sometimes, if you're not careful, some of them may even lead to what? You going home if you're not very careful. Now, that is on what? On the modern, those theories. Now, we want to go to the last bit. We call them what? Modern management theories. So there are people that have developed. So we have modern management theories. These other theories were not very modern. The classical theories, the behavioral theories, they are not so modern. Now, the modern theories are called what? We call them, we want to look at what? Some of the modern theories. And some of these modern theories, they're just improvement on those theories. Now, on the Mary-Parker-Follett theory, any question? On the Mary-Parker-Follett theory? On the Mary-Parker-Follett theory, any question? Before we go to the modern management theories? On the Mary-Parker-Follett theory, any question? Mutia is good. Neox has no question. JK has no question. So I think we are good. All of us are good. So thank you very much. I've seen people saying they're good. Now, let's go to the modern theories. We want to talk about the modern theories that we have. I don't know, or can I give you a 5 minutes break? Can you have a 5 minutes break? If people take a glass of water before we proceed? Any break? So let me give you a 5 minutes break so that at least some of you can take a glass of water before we can come back. So let's have a small. Lawrence, that is a very important activity. So we're going to give a 10 minutes break. We are at 1:20. By 1:30, let's be here. Let's give Florence also one of us a chance to ensure that other people also get their lunch. So let's have 10. We'll be here at exactly 1:30. So let's have a small break. Then we come back. The break was supposed to be a small break, and I believe that everybody is back. Confirm if you're back. The break, we're done with the break now. Confirm you being available now. Confirm if you're back. JK is back. Maina is back. Confirm. 2 people are back. Wanga, Joy is back. Ishmael is back. CPA Guru is back. Florence, where are you? Good. I think more than half are back, so we can proceed. Good. Thank you very much. Now, I want us to move to modern management theory. We'll look at some of the theories, and those theories basically they are quite traditional. So I want us to look at some of the modern theories that are being applied in the modern. We're not saying that those theories cannot be applied. Classical behavioral theories, they can still be applied, but in the modern way, we have theories that are more effective in carrying out our management function. Now, just to introduce say that modern management theories have evolved to address the complex and dynamic challenges faced by the organizations today. So, means what? These are theories that are current. So, they are brought about to be able to address the current challenges that you're facing, because the companies nowadays are working in a very dynamic and challenging environments, or dynamic and very challenging environments in terms of competition. So there needs to be modern theories to address those issues. So these theories focus on using scientific approaches, understanding organization interdependence, and adapting to changing environment. Means for you to manage a modern company, you must keep on changing the modern environment of applying the what. So then let's look at some of these theories one by one. We are talking about, these are just theories that are nowadays being applied. So they depend on scientific research. So let's look at some of these theories that we have. So the first modern management theory we're going to look at is called the quantitative thinking. And this one, you find that this one dwells more on a lot of research and statistics. Now let's define quantitative, not qualitative, but quantitative. Let's define this quantitative theory. So is that quantitative thinking or theory, is that quantitative thinking in management refers to the application of mathematical, statistical, and computational tools, decision making, planning, and problem solving in organization. So this basically, they apply some statistical frameworks to be able to make a decision. If, for example, you want to expand to another country, you use a statistical formula to determine or to help you make a good decision on whether to basically expand to a foreign country or not. You can also apply some of these mathematical or statistical methods to know how to improve your productivity in future. Now, what are the key concepts of this theory? What are the key concepts which are applied in this theory? Number one is operational research. And this is a very important area in the modern management. Talk about operational research, OR. So that uses mathematical models to analyze complex problems and optimize resource allocation. So let's say, for example, budgeting. You know that resources are normally very scarce, especially financial resource. Now, you can use operational research to help you determine how to allocate the few and scarce resources optimally to ensure that the company operates or achieve its objectives. Another concept is statistical analysis. So how is this one applied? The second one is statistical analysis that uses data analysis to inform decisions, e.g. forecasting. For example, if you want to forecast, if you want to predict demand of a given item that you use, then look at the historical data. What has been the demand of this product from the year 2020 up to now? So from the previous quantity used, you can predict the future. So you can apply a time series analysis or any other statistical formula to help you project what the need may be or the demand in future. Then the next one is the queuing theory. Very important. This one is nowadays being used in various. We have the queuing theory. So managers customer service systems like banks, call centers, or hospital. There's something called a queuing theory. I don't know. There's some place whereby when you call, for example, when you call customer service, you're told that you are caller number 12. There are 9 people ahead of you. So you wait until your turn is reached. If you go to the bank today, banking hall, where you want to pay your school fees through the bank, now you find that there are so many people. So you go and pick a ticket, and that ticket tells you your customer number and how many people that are ahead of you. So that if you find that maybe there are 30 people ahead of you, you can go and do something in town and come back and get served. Because you have the ticket. So because your ticket will be called. Those are called queuing theory. Even hospitals, people go and what? They're given numbers and then they're served as per they go and pick tickets. So that will help what? To ensure that aspect of what? So that I don't have to be on the line for 5 hours. If I know that I'm going to be served at 4, then I can go do something and then come back with my ticket at 4 and be served. Then we also have another one called linear programming. So it solves problems related to what? Maximum profit or minimizing cost. So you can also use a statistical linear programming technique to determine how you can be able to what? Get maximum profits or minimize costs. So basically, there are those statistical aspects. So this is basic scientific. Everything you do, you apply some statistics, some mathematical models to ensure that what they help make it. So basically, the outcome or the solutions of those models are what used to what? Make decisions. So that's how modern companies are being run. Now, what's the application of this quantitative approach? Where is it applied? What are the areas where this approach is basically being applied? So we say that it's being applied in scheduling production or workforce. You can use the queuing theory to what? Schedule that this one comes first, second, or workforce. If you're working, we have what's called a 24-hour economy, and we are working 8 hours a day, then basically we can use these formulas to what? To be able to allocate employees so that what? In 24 hours, we have somebody working in the office. Then also, in inventory systems, you can apply this in inventory whereby you receive stock, first come, first serve, or when you're selling, there's something called FIFO and LIFO. First in, first out, and last in, first out. So basically, you can apply this quantitative thinking in what? Then what? Financial planning and budgeting. Some of them might help you do financial planning. So you can use some of these statistical formulas or mathematical formulas, or some of these queuing theory help you in basically budgeting. And then supply chain and logistic optimization. Like, for example, you realize that even some of these big circles with so many vehicles, they have these formulas. So when there's, for example, there are more, let's say, for example, the one that the company is seeing with a lot of vehicles are, let's say, Super Metro. I use that one as an example. Now, Super Metro has got a fleet of cars. I think more than of vehicles, more than maybe 100. Maybe they could be in the tune of 200 or whichever, but let's use 100. Now, there are times when there's demand for passengers demand on a particular area. Maybe let's say, for example, there's a football match going to be done in Kasarani. Means what? There'll be more flow towards Kasarani. So basically, you can be able to use this mathematical formula to know how many fleet of vehicles or how many vehicles do what? Allocate to take care of because of what? Of the demand in those areas. So those ones are cost. Now, then what are the advantages of this technique or this model? The first one is that improved decision making through data and model. So every time you make a decision using this model, this techniques, you're able to back up. If somebody asks you, why did you put this amount of money in this department? You say that what? I used this statistical model, and from the findings, this what outcome. So I allocate the based on what? On this scientific proof. Nobody can. Then enhance efficiency and productivity. You become more efficient. And then last one, reduces uncertainty in managerial choices. There are times when as a manager, you don't know what to do. So if you're able to find a mathematical formula or a statistical formula that's able to help you, then basically you depend on. Sometimes you don't know what to do. You are at a crossroads. Then you say, okay, somebody said, we have this model that can help you what? Make the right choice. So basically, they reduce what? Uncertainty, whereby you make scientific decision. Now, then you have limitations. There are people that are also against this quantitative thinking. And their reasons are, number one of the challenges or one of the reasons why some people don't apply this one is, number one, over-reliance on numbers may overlook what? Human and behavioral aspect. So if you depend so much on calculations, data, you will fail to understand the human aspect or the human bit of how people are. So we don't just depend on numbers. Sometimes there's an aspect of what? of human interaction relations what? In relation to what you're doing. So that is something that this theory may overlook. It may overlook what? The human factor. This theory may basically overlook the human factor in terms of what? In terms of decision making. That is why we say that what? That's one of the challenges. Number two is require accurate data and skilled personnel. We see the one using statistics. So it requires what we call data. Anytime you're using a model to do calculations, then basically you must give in what? Good data, because that model is going to analyze the given information. So if you key in wrong data in SPSS, you're going to get wrong feedback. So we must ensure number what? Make sure that what? That data we're putting in these systems are very accurate. That would help us what? Make the right decision. And then last one, models may oversimplify real-world complexity. So some of these mathematical formulas may make findings very easy, but it's not easy in the natural setup, because the natural setup, you find other factors, economic factors. Talk about legal factors. So there are other factors that are under play that may affect decisions. But with this one, you depend on mathematical calculation. So sometimes it may overlook other real-time factors. Talk about technology, talk about political environment, talk about economic environment, talk about social. So basically, it doesn't look at what? The other aspect. You look at only the what? Statistics. That is on what? The first one called quantitative thinking. Anybody with a question on the quantitative thinking? Any question? Any question on the quantitative thinking? Any question? Can I assume you are good? We proceed. Hello? Zippo don't have a question. Zippy doesn't have a question. Lawrence, yes. JK, yes. Ismail, no question. So we are good. So that means we are free to proceed. Let's proceed and look at the second modern theory. And the second modern theory is, just a minute. The second modern theory is called the systems thinking. Now, what is this systems thinking and how does it apply? So we start by defining what is this systems thinking and how does it apply. So see that systems thinking views an organization, systems thinking views an organization as a system, a set of interrelated and interdependent parts working towards a common goal. This approach emphasizes holism, integration, and the interconnectedness of subsystems within nations. And so basically, what this systems theory talks about in short is that a company is like a system. Let's talk about, for example, breathing system, digestive system, is a group of interconnected organs or aspects. Now, a company is made up of semi-independent sections called departments or branches. All of them work to help the company achieve the what? Object. So basically, they're part of the system. So there's what the breathing system now. For example, me as human beings, we have the breathing system, digestive system, and other systems. And those systems help us to survive or help us to be alive. So the company also has got system. The accounting system for the accounting department, HR system, HR department, the production system. So basically, all these ones are part of the company. They help ensure that the company achieve its objective. Now, what are the key concepts in this approach or in this thinking? So that the first one is what? It's an open. The first concept is open system. What does it mean? So we say that organizations interact with the external environment, customers, suppliers, laws, and so basically, the company or organization normally interact with various environmental factors, the company interact with number one, customers, which are outside or external partners. The company interacts with suppliers. The company interacts with the law, the rules and regulations that govern operations of a company. They interact with the law. The company interacts with technology. So basically, those are external factors, but they help the company what? In achieving its objective. We call them what? They are external factors that help the company achieve its objectives. So we cannot work in isolation. We have to ensure that what? We embrace them. Number two is input, process, output, and feedback. So there are things that happen. And a company must have an input. There must be a time when the company, there must be an input. And then a company must also have a process. Once input come, maybe raw materials, they come to the company, they are processed. When they're processed, we have the finished product, which is the output. And that output is supposed to go to the customers, and then the customers give us feedback. So you say that a company has got what? Those three systems. It has got the inputs, it has got the process, it has the output and the feedback. Well, let's say, for example, we pick raw materials, which is the input, we process them, then you have the output finished products, we sell to customers. Customers give us output. So whether it's a service or a good, we have to go through that process. So that input resources are transformed through process to produce output, product, and services, which feed with the feedback influencing future operations. So the feedback we get from the customer determines the future operation. That's basically what you're saying there. Then we also have what we call a subsystem. Subsystems are departments or units. So about HR, marketing. So these are basically, we call them subsystems, like departments. Each of those departments, they are semi-autonomous, means they're semi-independent, but basically they depend on one another. For them to say that we have a company means a company is basically a collection of those departments, a collection of employees, departments, and branches. That's what makes a company. So that's what we say that a company is like a system. Now, what is the application? Let's look at the application of this systems approach. It's applied in number one, strategic planning. When you want to plan strategically, strategic planning basically means what? You plan for the future, then basically look at a company as a system and know that what? Each part of the system plays a crucial role in the company. That's number one. Number two is change management. If you want to implement a change, look at all aspects of the company and try to find out how can you be able to what? Help in implement a change. The number three is what? Is organizational development. If you want to develop a company, ensure that the communication touches all the parts of the company, so that the company system, everybody must know, whether the branch, the department, the section, all of them must have the information on what you want to do to ensure that the company develops. And then environmental scanning and adaptation. Sometimes when you want to operate as a company, you don't operate, a company does not operate in a vacuum. A company operates in an environment which has got both internal factors like employees, management structure, and those ones, and also in relation to what? External environment. Talk about political environment, economic environment, technological environment. So we call them the PESTEL: political environment, economic environment, social environment, technological environment, ecological environment, and also what? Legal. So basically, as a company, anything you want to make a decision, look at what? All those aspects. Now, what are the advantages of these systems theory or systems approach to management? What are the advantages? Number one is that what? It promotes a holistic view of the operational part. It means what? You look at a company as a body having several systems. So it helps you to understand the company. Anytime you look at a company as a system, then basically you understand what happens and the importance of every sector of the company. Number two is what? Enhances adaptability and long-term planning. Means if you look at a company as a system or holistically, then basically you can know how to adapt the prevailing environmental factor. At the same time, you're able to ensure that what? You can plan long-term because you know what is needed and what's there. Then encourages what? Interdepartmental collaboration. As a department, you cannot operate in isolation. You must collaborate with other departments. So it's like, for example, the head cannot be there without the neck. The hands are there, the eyes, the nose. So basically, that's what happens. As a department, you are semi-autonomous. Means what? You are semi-independent. You cannot be fully independent. That's what happens. Now, what are the limitations of this theory? Some people are against this systems approach, and they say that what? These are the reasons. So what are some of the problems or the limitations? Number one is what? Complex to implement and manage. It is very difficult to understand your company in totality. And applying this system requires experts, and sometimes you need what? A consultant. So it's not easy. Number two, difficult to analyze the impact of each subsystem. it sometimes can be difficult to know the contribution of each system can be difficult. And then maybe challenging to pinpoint accountability. Very difficult to be able to do what we call apportion accountability aspects. Who did wrong? So sometimes it's difficult to trace, especially if you have a big company. These multinational companies can be very difficult for you to be able to check on this aspect or understand this aspect. So that is what's called the systems approach or systems theory. Is it understood? Is the systems theory understood or understood? Any question? Is the systems theory well understood? People are quiet. Hello? Are we in class? Now I'm starting to call name by name. CPA Guru, Florence, Ismail, JK. This class, we say that in my class, you have to interact. I must see you writing at the chat forum so that I know you are present. At the same time, it helps you to be able to be like, so I need to see, if I see you in class and then I don't see you interacting, then basically, I assume you're not getting what I'm saying. So always try to interact with the chat forum so that I know we are together. Now, so I've not seen anybody asking a question. So let's go to the last one, which is called what? Contingency thinking. This is the last bit. So let's look at this also, one of the modern management theories. You talk about contingency means what? You try to ensure that what? You look at, put measures in place to ensure that what? You're able to, in case of any emergency, you're able to what? Have a way of managing. So when thinking, accept that there is no one best way to manage an organization. Instead, the most effective management style, structure, organization depends on the various contingency factors like what? Environment, technology, size, and culture. Means what? They say that what? There's no one best way to manage a company. How you manage a company depends on environment you are in, technology, size, and the culture. That's very true. You cannot copy-paste somebody's management style and go and put in yours because there are a lot of things that are different. The resources you have are different from them. So basically, try to find a way in which what you're able to look at. So manage your company subject to what? Factors that you have. Now, what are the key points here? The key points are two here. The first key points are two here. Number one is what? Fit or alignment. So managers practice must align with the context. How you manage your company must what? Align with the context in which your company is, where you operate as a company, the size, the structure, the environment, basically determines what you look at. Thank you very much. That is very true, Zipporah. That's what. So Zipporah has just added that's just to add on systems. Functions according to the strategies are terms as open systems, environmental dependence, and environmental serving. So basically, you manage your company subject to what is happening. Don't copy paste. There are other management that they're universal, but basically how you apply them depends on what? On the company, that on how you, on the environment you operate in. So the key concept, and number one is fit for alignment. So management practice what? Must align with what? Context. So your management practice must align with what you want to achieve. Number two is what? Situational variables. So internal resources and external competition laws, condition influence what? So what they're saying is that what? Different situations determine the decision you make. There could be resources, there could be goals, there could be competition and the laws. The situations that are inside or outside the company can affect how you what you do. And then adaptive management. So leaders must be flexible and responsiveness. Don't have a rigid management structure. Ensure that what? You are able to be flexible. The world is changing very, very fast. Things are changing. So as a manager, don't be very rigid. Embrace new things that are able to what? Help your company become what? More competitive. So that's called what? Adaptive management. Look at that and check on it very, very well. Then application. Where do we apply this contingency approach to management? How do we apply it? So we apply it, number one, is choosing between autocratic and democratic leadership style based on the employee skill level. So the nature of the employees you have will determine the leadership style you apply, whether you become autocratic, a dictator, democratic, or transformational. So basically, the nature, how your employees are determines how much you manage. Then number two is what? Structuring company. So centralized depending on what the size. So basically, there's something called organizational structure. We can manage the company in two ways. We can centralize or decentralize. Centralize means what? You have like one head office, which decisions are made at the head office. But decentralize means what? You can now make decisions at the unit level, maybe departmental level or the branch level. For example, before constitution, before we had the new constitution, we used to have what's called what? National government running everything. But now after constitution, new constitution, now we have counties. Counties are decentralized government operations. We have national government. So the decisions that can make at the county level, so we call them what? Decentralized. So power has been decentralized. Now, then designing motivation strategies suitable for different. So basically, I say that what? Each employee will be motivated differently, subject to even the Maslow hierarchy of needs. So don't say that you have one way to motivate all employees. You must understand your employees to know what motivates each and every employee. Very, very important. Look at, so every employee will motivate by different factor. So don't apply one that this one motivates, but I know money is a universal motivator. Now, then advantage of this contingency approach, why do some people believe in it? Number one is what? Encourages flexible and what? Context sensitive management. Means you manage subject to context. So you're sensitive, you're flexible. If things change, you change how you manage things. You don't say that this is how we manage this year. No. If January, things change in March, you employ what? Or you adapt a new style of management. Number two, improve organizational effectiveness in diverse what? Environment. You become effective because what? You are ever changing to meet or to suit what? The environmental changes. So basically, you then avoid rigid one-size-fits-all approach. When you talk about rigid one-size-fits-all approach, means what? You copy-paste. You say that how you managed last year is the same way this year, how you met in January, same as December. No, you try to ensure that what? You manage subject to what? Prevailing conditions. And then limitations. Number one, requires managers to analyze many variables which can be complex. So applying this contingency approach can be very complex because what? You have to put into relation all the factors. Then number two, not always clear with contingencies matter most. Now, for example, which contingency do you give more attention than others? So basically, because you cannot rank contingencies, then applying this management style can be very, very challenging. And the last one may lead to what? Inconsistency practices across departments. You find that what? Marketing people are using their own way of doing things, accounting people, so find out everybody is facing. So you find that in a company, you're applying different styles in different departments, which cannot be good for the uniformity of the company. So basically, those are the challenges. Any question on that point? Any question on the contingency approach? Because our time is up also. But in case you have a question, you can list it down. We have it, we dispose it next time before to the next topic. So I've been able, this recording will be shared with you later. So I want to thank you for your time and for your patience and for you coming. Let's meet again next time. But we are still, our Facebook, our group is open. If you have a question, just put it there, we'll answer it. No, but get, huh? No, but get to know that you have a special student. Florence, that one I know. And I'm taking that one very seriously, Florence. Yes. Florence will interact more as time goes by, and we will ensure that you pass exams, Florence. That one I can assure you. So you people have a good day, a good weekend ahead. Let's meet again next time for the next class. Thank you very much.
a lawyer to be able to assist us in reforming or basically registering that particular company. That lawyer we have engaged is not a promoter. Because he has been engaged, we have engaged that particular lawyer in a professional capacity, basically to assist us in registering what? The company. So therefore, a promoter does not include any person who is involved in the formation of the company at a professional what? A capacity. Maybe first of all, we can say that this is a founder of a company, a founder of what? Of the company. And still we can also say that this is any person who undertakes to do what? To form the company, to form the company with respect to a given project, with respect to a given project, with respect to a given what? A project, and set the company as a going concern, and set the company as a going what? As a going concern, as a going what? A concern. And that is basically the definition, a simple definition of the term who, or basically this particular person who is called the promoter. I think that simply what was required. Then let's move to part B of the question. And basically what was required in part B is we explain the rules which governs the pre-incorporation contract. So the rules governing what is called the pre-incorporation contract. Pre-incorporation what? Contract. Pre-incorporation contract. Pre-incorporation contract. Pre-incorporation contract. Now, remember in this case, we said that when we talk about the pre-incorporation contract, these are those particular contracts which are entered into on company's behalf before the company is registered or before the company is incorporated with the registrar of companies. In other terms, we refer to this particular contract here as the preliminary what? Contract. Any contract which is entered into by the promoters on behalf of the company, but before the company is registered with the registrar of companies, is a pre-incorporation contract. Essentially, what we say is that this particular contract, as far as the company is concerned, they are null and void because they are contracts which were entered into before the company was registered. And actually, we say that until such time the company is registered with the registrar of companies, the company do not have contractual capacity. The company do not have the ability to enter into any contract. So therefore, that's what we are saying, that this particular contract, as far as the company is concerned, they are actually deemed to be null and void. They are actually deemed to be null and void. This particular contract here do not have any legal implication. If, for example, they are breached, by the end of the day, the company cannot be sued in a court of law. If the third party breaches that contract, the company cannot be able to go to a court of law, take a legal action against that particular third party. And therefore, what we see is that once the promoters have entered into this particular contract on company's behalf, then they will always be held personally liable. So if those particular contracts are breached, the company cannot be held liable, but rather the promoters, we said, are the one to be held liable for the breach of those particular contracts. So what the question was asking, and the rules which governs this particular contract. And I think we discussed on the legal provisions, which are the same with the rules. So number one, we said that this particular contract here, we said number one, they are null and void. They are null and void. Null and what? Null and void. And also unenforceable. They are null and void and unenforceable. Unenforceable. So basically what that means is that this particular contract here do not have any legal implication as far as the company is concerned. So if they are breached, the company cannot be sued, and equally the company cannot go to a court of law and basically take a legal action against the third party for the breach of those contracts. So they are null and void and also unenforceable. Number two, we say that the promoters are personally liable. Promoters are personally liable. Liable for the breach of this contract, for the breach of this contract. So mean that if this particular contract are breached, automatically the company cannot be sued in a court of law. So the promoters are the one to be held personally liable for the breach of this contract. But equally in this case, recall, we talked about the various ways through which the promoters can avoid their personal liability. And actually, that is a very, very common question, whereby you can be required to explain various ways in terms of how the promoters, the founders of the company, can avoid being held personally liable for the breach of this particular contract. We talked about so many ways. Number one, we say that we can, or the promoters can enter into this contract in draft form. In draft form means that they will just negotiate those contracts on behalf of the company, but the contract will only be executed. The contract will only be performed once the company is registered. So they just negotiate the contract, but they will also agree with the third party that this is a contract we are negotiating on behalf of the company. The contract will only be executed, will only be performed once the company is registered. Number two, we said that the promoters can also avoid their personal liability by doing what? By basically including a clause in this particular contract that they can only be held liable up to the time the company is registered. Once the company has been registered with the registrar and the contract is breached, then they cannot be held personally liable. On the other hand, we say that the promoters can also do what? Can basically ensure that once the company is registered, the company enter into a new contract to substitute the pre-incorporation contract. So mean that once the company enters into a new contract with the same third party, the pre-incorporation contract between the promoters and the third party will be terminated and replaced by a new contract between the company and the same third party. And actually we say that is basically known as novation. That is known as what? Novation. So we talked about so many ways through which the promoters can actually be able to avoid their personal liability. And actually we said you need to understand, to remember those various ways through which the promoters can avoid their personal liability. Number three, the other rule which governs this particular contract, we say that the company cannot sue the third party. The company cannot sue the third party. The third party in case of the breach. In case of what? In case of the breach. So if the third party breaches this particular contract, the company cannot be able to go to a court of law, take a legal action against that particular third party. Number four, here we said that the company equally, or the third party, that is, the third party cannot sue the company, for the breach. The third party cannot sue the company for the breach. For the breach of what? For the breach of the contract. For the breach of what? Of the contract. So in case this particular contract is the breach, then you are saying that this particular third party cannot be able to do what? Cannot be able to sue the company for the breach of that particular what? Contract. Number five, here we said that the company can do what? Can enter into a new contract. Can enter into a new contract. Contract to substitute. The pre-incorporation contract. The pre-incorporation contract through a process which is called what? Novation. Through a process called what? Novation. So the company, once registered, can enter into a new contract with the same third party, whereby the pre-incorporation contract would be terminated and basically replaced by a new contract between the company and the same third party. Also, on the other hand, we say that the members of the company cannot ratify. The members of the company cannot ratify this contract, cannot ratify this what? Cannot ratify this contract. So the members of the company, maybe once the company is registered, cannot pass a resolution ratifying this contract. So to ratify the contract means that the members cannot pass a resolution to approve that. In case maybe the contract is breached, the company can be held liable. They can't do that. The members of the company cannot pass a resolution to do what? To ratify this particular what? Contract. So therefore, those are basically some of the legal principles, or basically some of the rules which basically governs this particular contract here, which are known as the pre-incorporation contract. So let's move to the last part of that question, and we are told, describe the common law duties of the promoters. So the question here is asking about part C, common law duties of a promoter. Common law duties of who? Of a promoter. The common law duties of a promoter. Now, remember in this case, what we say is that during the formation of the company, basically we say that the promoters are expected to perform various duties And actually say that the duties of the promoters are basically broadly classified into two categories. Number one, we talked about the fiduciary duties, and number two, we talked about the common law duties. The common law duties. So therefore, the duties of the promoters are broadly classified into two. So the question here was asking about the common law duties. But before even we look on those common law duties, recall we said that the fiduciary duties, these are those particular duties which arises out of the fiduciary relationship which exists between the promoters and the promoters, and basically the promoters and the company to be formed. Remember, in this case, we said the promoters basically are regarded to be the trustees of the company. They are regarded to be the trustees of the company. So therefore, as a result of that fiduciary relationship, there are a number of duties which are expected from these promoters. Which are those duties? Number one, we talked about the duty to account. We say, if, for example, you're a promoter, you're given some amount of money to do a number of things on company's behalf, you must account. You must explain how you spent that particular amount of money, of which you say that accounting basically has to be honest. You must explain how you spent that particular amount of money, even necessarily support that with the necessary receipt. If you paid a number of items, you paid a number of expenses, support that with a relevant document. So then from there, we also talked about the duty of disclosure. In this case, we said that the promoters are expected basically to disclose two things. One is any secret profit. If you make a profit as a promoter, make sure you disclose that. Number two, the promoters are also expected to disclose any personal interest. If, for example, you have some personal interest in a transaction, in a contract you are entering into on company's behalf as a promoter, you need to disclose that to the other promoters. And finally, number three, we talked about the duty to act bona fide. The duty to act bona fide. We say as a promoter, anytime you are doing something on company's behalf, you must do it in the best interest of the company. You must do it in the best interest of what? Of the company, in the best interest of what? Of the company. So therefore, we talked about those three fiduciary duties, the duty to account, the duty of disclosure, and the duty to act what? Bona fide. So let's now look on these common law duties, the common law duties of promoters. The common law duties of the promoters, common law duties of promoters, common law duties of who? Of the promoters. Now, when we talk about the common law duties of the promoters, number one, we say that these are the general duties. The general duties of the promoters. So these are what? These are general duties, general duties of who? Of promoters. Of promoters during the formation of what? During the formation of the company. Formation of who? Of a company. During the formation of who? Of the company. So, and these duties, we said they include what? We said they include number one, basically to do what? To come up with the company's name. Come up with the company's what? Company's name. So it is basically the responsibility of the promoters to come up with a company's name and have it reserved. And have it reserved. And have it reserved. And have it what? Reserved. Now, the other duty of the promoters, the other duty of the promoters, or that is the other general duty. And I've said that these are general duties. These are general duties. So the other general duty of the promoter is basically to register the company. To register the company with the registrar of companies. So it is the responsibility of the promoters to do what? To register the company, with the registrar of companies, with the registrar of companies. Number three is that the promoters here do have the responsibility to appoint the first directors of the company, first directors of a company, to appoint first directors of the company. Number four, we say that they have a responsibility to do what? To meet, or in other terms, to pay the preliminary expenses. Remember, in this case, we said preliminary expenses. These are those particular expenses which are incurred during the formation of the company. Who should pay those particular expenses? It is the founders of the company. That is the promoters. They have a responsibility to pay those particular what? To pay those particular expenses. On the other hand, we say they have a responsibility to acquire basically assets or what? Or property for use by the company. By who? By the company. So they have a responsibility to acquire property or asset for use by who? By the company. On the other hand, we say that if the company which is to be registered is a public company, the promoters do have a responsibility to prepare the prospectus. So we cannot talk about to prepare the prospectus if the company registered is a public company. If the company to be registered is a public company, the promoters do have that responsibility basically to do what? To prepare a prospectus. Remember, we say that a prospectus is basically that document or basically an invitation by the company inviting the members of the public to do what? To subscribe the shares of the company. The shares of what? Of the company. So that particular prospectus has to be prepared by who? Has to be prepared by the promoters. The promoters have a responsibility of preparing that work, of preparing that particular prospectus. So therefore, those are basically the general duties of who? Of the promoters. And I think that is it, that what was required as far as that question is concerned. That question is concerned. That is question number 5. So let's move to the other question, that is question number 6. In question number 6, part A, it reads, identify the different types of meetings that may be held by a public limited company 8 months. So in that case, we are required to identify, in other terms, to do what? To explain different types of meetings which may be held by a public limited company. Remember, you say that once a public limited company has been registered, has actually been formed, that company may convene, in other terms, may hold different types of meetings, different types of what? Different types of meetings. So question number 6, question number 6, part A, types of meetings, types of meetings that may be held, that may be held by who? By a public limited company. So types of meetings that may be held by a public limited company. So I think we talked about 5 types of meetings. 5 types of meetings. Yes, I think we talked about 5 types of meetings. Number 1, we talked about a meeting which is called AGM. The AGM, that is the annual general meeting. The annual general meeting. So remember, I said that the AGM, annual general meeting, this is a meeting which all the public limited companies are required to convene on annual basis. On annual basis, so mean that this meeting here is held on annual basis every year. That a public limited company has to convene this meeting. And actually, we say that private companies are not under any obligation to convene these meetings for their members, to hold these meetings for their members. Number 2, we say that these particular meetings should be held before the end of 6 months in the following financial year. Meaning that if, for example, a company is to hold maybe an AGM for 2025, that meeting actually will be held the following financial year 2026, but equally before the end of June. So it is held before the end of the 6 months in the following financial year. And actually, we say that this particular meeting is for it to be convened, the members, we said, must be served with 21 days notice. On the other hand, we said those businesses which are transacted in this meeting, we refer to them as ordinary business. Ordinary business. And I think we were able to look on the various businesses which are transacted during what? During the AGM. So those businesses include what? Number one, appointing the company's auditor. That is one of the ordinary business, appointing the company's auditor. Number two is electing the directors. Number three is basically a declaration of payment of dividends. The other one is what? Is the consideration and the adoption of the audited financial statements. And the other one is about what? Is about what? Consideration and also confirmation of the minutes of the previous AGM. Of the previous what? AGM. So therefore, we talked about those as the different types of businesses, ordinary businesses, which are basically transacted during what? During the AGM. During what? The AGM. So the other type of meeting which may be held by this company is something called the EGM, extraordinary general meeting. So extraordinary general meeting, we say that this is any other meeting, held other than AGM, and also what? The statutory meeting. The statutory what? Meeting. And actually we say that this particular meeting here is convened to transact what is called the special business. To transact the special what? Business. When we talk about the special business, we are referring to those particular businesses which cannot be transacted during the AGM. During what? The AGM. And actually we say that this particular meeting here can be convened either by who? By the court upon application. It can also be convened by the directors. Or it can also be convened by the requisitionist. Remember, in this case, I was able to explain who are the requisitionists. The requisitionists are basically those particular members of the company who had requested the directors to convene this meeting, because we talked about certain number of members who may request the directors of the company to convene this meeting. We say once the directors have been requested to do that, they must convene the meeting within 21 days. If they fail to do that, then those members who had requested the meeting to be held, who are now known as the requisitionists, they can go ahead and basically convene that particular meeting. So the other meeting, which can also be convened, in other terms, held by a public company, is something called a class meeting. A class what? Meeting. And actually we say the class meeting is a meeting of a certain class of who? Of shareholders. A certain class of who? Of shareholders. A certain class of shareholders. For example, in this case, we say that if the company has issued maybe the ordinary shares and also the preference shares, we said that the company can convene a general meeting of the ordinary shareholders, or the company can convene a general meeting of the preference shareholders. So that particular meeting is known as a class meeting. And actually we say that that particular meeting is ordinarily held by the company to approve something called the variation of a class rate. Variation of the class what? Of the class rate. When we talk about variation of the class rate, it basically means that this is a meeting which is convened by this company to do what? To approve some changes in relation to some rights affecting a certain class of shareholders. If, for example, maybe the company wants to, the directors are proposing the rate of dividend, the rate of preference dividends, maybe to be reduced from, assuming the company currently is paying 12%, the directors have proposed to reduce that rate of preference dividend, maybe from 12% to 10%. So that one has to be convened, or actually that company would be required to convene a general meeting, not a general meeting per se, but a class meeting of the preference shareholders, whereby the preference shareholders will come in and basically discuss that issue, approve it by a special resolution. So then from there, we also talked about the other meeting which may be held. Let's talk over the board meeting. The board what? Meeting. After we say the board meeting, this is a meeting of the members of the board, is a meeting of the directors of the company. We say that this meeting may be convened anytime. There is no timeline when this meeting should be held. So it may be convened anytime. basically for the director to be able to do what? To transact a number of businesses during the board meeting. And I think also we talked about something called the statutory meeting. I hope you can be able to recall, we said statutory meeting basically, this under the new Companies Act, companies or public companies are not mandated. They do not have any responsibility to convene this meeting. But you said the new Companies Act states that any company which was formed under the repealed Companies Act, under the old Companies Act, it had not convened this particular meeting. You have to go ahead and convene that meeting. But we said under the new Companies Act, Companies Act of 2015, public companies are not under any obligation to do what? To hold that meeting. In other terms, any company which is registered in accordance with the Companies Act of 2015, that company do not have a responsibility to do what? To convene that meeting. So therefore, these are different types of meetings which may be convened, in other terms, which may be held by these public companies. So 8 marks for that. So part B of the question reads, state the rule in Sharp versus Davis and explain the exceptions to the rule. The rule in Sharp versus Davis and the exemptions and the exemptions So this is a rule which we discussed in this topic of meetings, in the topic of meetings. And actually we say that this particular rule here, the rule in Sharp versus Davis, basically states that a meeting of a company cannot be duly constituted if attended by one person, even if that person is attending the meeting in more than one capacity. We said you can attend a meeting in more than one capacity. This whereby you're attending a meeting as a member of the company, and also you're attending as a proxy. You are representing another member. Provided it's only one person who is present, that meeting shall be deemed not to be properly constituted. So the rule state that a meeting of a company cannot be duly constituted by one member, even if he or she is attending the meeting in more than one capacity. In more than one capacity. In more than one what? Capacity. Even if that person is attending the meeting in more than one capacity. So attending the meeting in more than one capacity means that he's attending the meeting as a member and also as a representative, as a proxy of another what? Member. So that basically what this rule states. Then from there, we can give the exceptions to the rule. Exceptions to the rule. So first of all, what do you mean by the exceptions to the rule? What do you mean by the exceptions to the rule? The exceptions to the rule, basically, these are the circumstances whereby the meeting of a company can be duly constituted by one person. So only one person who attended the meeting, but the meeting shall be deemed to be properly constituted. And actually, any resolution which is passed in such a meeting shall be deemed to be valid. Shall be deemed to be what? To be valid. So which are those circumstances? Which are those instances whereby the meeting of a company can be duly constituted by one person? Number one is what we call the creditors meetings. The creditors meeting during the company's liquidation. During the company's liquidation. Now, if you can be able to recall what we said in relation to the topic of company's liquidation, we say whenever a company is being liquidated, meetings of creditors must be convened. One of the main objective of these meetings of creditors is for the creditors to be able to prove their debts, because we say that if, for example, by the time the company is liquidated, you are claiming you're claiming some amount of money from the company as a creditor. There is an amount of money you have not been paid by that company. You have to prove. Which goods did you supply to that company? Do you have a supporting document? Which services did you provide to the company? Do you have a supporting what document? You have to prove that. So therefore, we said there should be a number of creditors meetings. And now, in this case, we said if a company has got a single creditor, then that is the person who is entitled to do what? To attend those particular meetings and do what? And actually to attend those meetings. So therefore, during the company's liquidation, the meeting of creditors can be constituted. A creditors meeting can be constituted by one person where the company has got a single creditor. So number 2, we talked about the board meeting. The board meeting of a private company. The board meeting of a private company. Board meeting of a private company. So in this case, we said private companies here are required to have a single director. And therefore, if a private company has got a single director, one director, that is the only person who is entitled to attend the board meeting. And that board meeting, even though attended by one person, the meeting shall be deemed to be properly constituted. Number 3, we talked about what we call as the adjourned meeting. Adjourned meeting. So when we talk about adjourned meeting, this is a continuation of a meeting which was postponed due to lack of quorum. Remember, I said that if, for example, a company has convened maybe a general meeting of members, and the meeting do not have a quorum within 1 hour of the appointed time, within 1 hour from the time the meeting was supposed to start, then we say that the meeting will have to be called off. In other terms, the meeting will have to be postponed, or in other terms, it will have to be adjourned. It will have to be discontinued. We said the company should convene, or another meeting will be held next week, the same place, the same time, unless resolved otherwise by who? By the directors. And actually, all the members would be notified that the meeting didn't take place because there was no quorum, and therefore they are expected to attend the following week. So if coming next week, still one member attend, that meeting shall be deemed to be duly what? Constituted. And actually, the meeting shall proceed and transact those businesses which were supposed to be transacted by the members. So adjourned meeting. So then we have number 4. Number 4, we have what is called a meeting convened by the registrar of companies. So the registrar of companies can issue an order requiring a company to hold a certain meeting. And equally in this case, the registrar will still order that even if a single person attend, the meeting basically go ahead and basically transact those particular businesses which the registrar of the companies which the registrar has actually ordered to be transacted in such a meeting. So number 5, we have a meeting convened by a court order. So these are those particular meetings which are convened as a result of an order issued by the court. So in this case, the registrar will equally do what? Will equally not the registrar, rather the court will actually may order as a meeting to be convened, and still order that even if that meeting is convened is attended by one person, the meeting should go ahead and transact those businesses which the court has ordered to be what? To be transacted. To be what? To be transacted. To be what? To be transacted. To be what? Transacted. Yes, automatically this one should be the High Court. This one should be the High Court. This one should be what? This one should be the High Court. Yes, I think we can talk over those 5 exemptions, but also remember we have others. We have other what? Other exemptions. We also have other exemptions. So I think maybe we can just talk over the 5. We can talk of the 5, but remember we also have others. Yes. So let's go to the last part of the question, whereby we are required to define what is a special notice. What is a special notice? What is a special notice? Special notice. Special notice. Now, we say that special notice, basically, this is a notice which must be given to the company by its members 28 days before. So the number of days is very important. 28 days before before a certain meeting. For example, in this case, we say if the members of the company intend to remove the director or one of the director in the forthcoming AGM and maybe replace him with another director, they want to remove the auditor and replace him, the returning auditor, replace him with another auditor. So they must give the company a special notice. So therefore, this is a notice given to the company by members 28 days before the day of the meeting, 28 days before the meeting, before the meeting, informing the company about the intention to pass a certain resolution. So this is the notice which is given by the members 28 days before, that is given to the company by the members 28 days before the meeting or before the date of the meeting, informing the company about the intention to pass certain a resolution. Equally, we can say that this notice is required for what? Or when should this notice be given to the company? When should this notice be given to the company? Number one is when the members of the company intend to pass a resolution to do what? To reappoint a director who has attained the retirement age. So this notice is required for a resolution to do what? To reappoint a director. Who has attained the retirement age. The retirement age. And who can be able to recall? We said a director should retire after attaining the age of how many years? A director should retire after attaining the age of how many years? A director should retire after attaining the age of 70 years. The age of 70 years. So we said, assuming a director has attained the age of 70 years, maybe in April here, and maybe our company will be holding its AGM in June. So basically, we said this particular director here, who has already attained the retirement age, is not supposed to retire in April, but rather this director is supposed to notify the company that he has already attained the age of the retirement age of 70 years, and that director is supposed to retire in the forthcoming AGM. AGM. So automatically, in the notice which will be sent to the members about this AGM, the members will be notified that one of the directors has attained the retirement age, and therefore he will be retiring in the forthcoming AGM. But in this case, the members of such a company may be happy with the services or with how that director has served the company, and they wish to reappoint him back despite having attained the age of 70 years. So we said for the members to do that, they must give the company a special notice. They must notify the company 28 days before that AGM that they want to reappoint that director back in the office despite having attained the age of 70 years. That's why we are saying that this notice is required, number one, for a resolution to reappoint a director who has already attained the age of 70 years. Number two, this notice is also required for a resolution to remove the auditor from office, to remove the auditor. Number three is also required for a resolution to remove the director. To remove who? The director. So therefore, this particular notice here is required for those resolutions. Is required for those what? Is required for those resolutions. Yes. So that is it. That basically what is required as far as those questions are concerned. Those questions are concerned. So what I want us to do is maybe just take a short break of 10 minutes, and then we come back. I want us to look on this other paper. That other paper. I've reshared the paper in the class WhatsApp group. So we come back and basically look on some of the questions from that paper. From that paper. Yes, so we take a short break. Short break of 10 minutes. We come back at 1:15. 1:15. We should take the effective interest rate, because I hope you can see we have two interest rates. We take the effective interest rate, which is also called the market interest rate, and basically we multiply that with what? We multiply that with the par value of the both. We multiply that with the par value of what? Of the both. So out of the two interest rates, because we have 8% interest rate, and also we have 12%. So if you check on the information we have in note 1, 12% is the effective interest rate. So therefore, to compute the interest expense, we will take 12% of the par value of the boat. So the par value of the boat is basically what we have in sentence 1. We are told these boats were issued at par value. 450 million is the par value. Remember the par value, this one can also be known as the nominal value. This one can also be known as the face value. So, and I think this was giving us 54 million. Remember, you had computed some of these items. Was it giving us 54 million? 54 million? You confirm that? Were we getting 54? Stella? Henry? Yes, we were getting 54 million. Then after computing this, we say that we need to compute the amortized cost, cost of this particular what? Of this particular boat. How do we compute this particular amortized cost? So to compute the amortized cost, we basically take the amount for initial recognition, amount for initial recognition. To this, we add the interest expense which you have computed up here. Basically, I'll be able to explain how we compute this. And then to this, we less the cash paid. The cash which was paid. Now, the cash which was paid, this one is computed by taking the coupon interest rate, and then equally we multiply that with the par what? We multiply that with the par value. So if coupon interest rate, in our case, is what we have here, 8%. Basically, multiply that with the par value. We have said the par value of this boat is 450 million. And this was giving us an amount of how much? Was it 36 million? 36 million? Yes, 36 million. Now, how do we determine this amount for initial recognition? The amount for initial recognition, basically this one, is equal to the fair value of the consideration received. Fair value of the consideration received. No need to cram this because I've seen there is a full topic you're going to do in relation to financial instrument. So we take the fair value of consideration received. How much amount were these boats issued at? So in our case, we know they were issued at the par value of 450, and then to that we should raise any issue cost. In our case, we take 450 minus the issue cost. There is some information which are given within still note 1, sentence 3, and you're told there was no issue cost. There was no any issue cost. So if there was any issue cost, we basically rest it there to get the amount for initial recognition. So in our case, the amount for initial recognition therefore will be 450. So therefore, this is basically how we compute the amortized cost of this particular boat at the end of what? Of the year. So this will give us an amount of how much? This will give us an amount of how much? This one plus this minus. Yes. So basically that was giving us 468 million. So meaning that in preparing our statement of financial position, this boat will actually be recognized in the statement of financial position as a liability at this amount. Now, when preparing the income statement, what we recognize there is basically this one. So this one will be recognized as an interest expense in the statement of profit or loss. So that's basically what was required there. So let's move to point number 2. In point number 2, we are told as at 31st of March 2022, which is basically the end of the current year. So the directors of Delta Bank Limited accepted a valuation report by a professional valuer, which revealed that the fair value of the property, plant, and equipment was 2,500 million. The carrying amount of the property, plant, and equipment was 1,850. So this is an item of property, plant, and equipment which was revalued. So you can see we are given its carrying amount, which is the same with the net book value, and also we given the revalued amount. So anytime an asset, an item of PP has been revalued, so definitely what we have to do is basically to determine whether there was a revaluation gain or basically whether there was a revaluation what? Loss. So we need to determine whether there was a revaluation gain or a revaluation what? Loss. And basically, how do we determine that? we have to compare two values. We compare the revalued amount and the carrying amount, and the carrying amount, and the carrying amount, and the carrying amount. Now, is my video clear? Someone is saying my video is not yet clear. Video iko sawa? Video iko sawa? I can see someone who is saying the video is not okay. Is it John? Okay, yes, I'm told my video is clear. I'm told my video is clear. I'm told the video is clear. Sasa, so John, check what is happening. You can log, you can exit, then you rejoin, log out and then log in. So we see whether there will be some improvement. Sasa, yes. So in that particular case, we are saying this is an item of PP which was revalued. So what we need to do basically is we determine the revaluation gain. So this one is quite simple. So we just compare the revalued amount, So this item was revalued at an amount of 2,500 million, and then you're given its carrying amount. Remember, the carrying amount of an asset is the same with the net book value. So the net book value is 1850. So basically, in this case, you can see this item was revalued upward with an amount of 650. So this 650 is what is a revaluation gain. And remember, you say that this particular 650, this one should be accounted for as part of the other comprehensive income. Being part of the other comprehensive income, this one should be added to the profit for the year. Yes, but remember there was a deferred tax to be computed on this. Let's go to the last paragraph of note 2, and you're told the directors do not make any inter-reserve transfer upon revaluation. However, they do account for the deferred tax on the revaluation of property, plant, and equipment. Revaluation is yet to be accounted for in the books of the bank. So basically, this company, we are told, accounts for deferred tax on the revaluation. So if you you can be able to recall what you did in financial reporting. You are told anytime the company has revalued an item of PPE, there is a revaluation gain. We compute something called the deferred tax on revaluation gain. So how do we compute that deferred tax? The deferred tax on revaluation gain. So the deferred tax on the revaluation gain, this one is computed by taking the revaluation gain times the tax rate, So the revaluation gain is 650, and then tax rate. We have it in note number 3. Note number 3, the last sentence, basically we are told the applicable tax rate is 30%. So this was giving us an amount of how much? Was it 165? 185 million, eh? Yes, 185 million. So how do we account for this? We say that this one is basically accounted for by debiting the revaluation reserve account. To debit revaluation reserve is basically to reduce. Now, we say that this particular amount here, which is a revaluation gain, this one should be debited in the PPE, credited in the revaluation reserve. It should be added to the PPE and then added to the revaluation reserve. But because there is a deferred tax associated with it, then we say that we will have to reduce this with an amount of 195. To debit revaluation reserve means we need to reduce that with an amount of what? 195. And then this one we said should be credited in the account which is called the deferred tax account. The deferred tax what? Account. So therefore, this particular revaluation gain here, the revaluation gain, which you're going to recognize in the income statement as part of the other comprehensive income, has to be net of deferred tax. So therefore, we will take the revaluation gain, which is basically 650 million, 650. Then we are saying we debit the revaluation reserve. To debit is to reduce this. We deduct it from this, which is basically 195. And this was giving us an amount of how much? For something, for what? What is the net amount? 650 minus 185. Yes, so this one will give us 455 million. So this one is what we will recognize in the income statement as part of the other comprehensive income, the revaluation gain, but it has to be net of the deferred tax. And then when preparing the deferred tax account, this particular amount would be credited there. That should be the double entry for that revaluation what? For that deferred tax or the revaluation gain. We deduct it from this amount, and then when preparing the deferred tax account, we credit it there. So we are done with that point number 2. Let's move to point number 3. In point number 3, this basically was examining something to do with the income taxes. There is a full topic you're going to do in relation to that, no need to worry. So we are told during the year, which ended 31st of March 2022, the current tax on profit was estimated to be 890. So this is basically the current tax, which is basically 890. So if you can be able to recall what you did in financial reporting, so usually this particular item here can only be adjusted with something called the over provision or under provision of current tax from the previous year. I hope you can be able to recall. If, for example, there was any other provision from the previous year, we add it here, other provision of current tax from the previous year. But if there was an over provision basically should be deducted. Over provision of a current what? Of current tax. So that is the only adjustment which we make to the current tax. So any other provision of current tax from the previous year, we add it here. Any over provision, we do what? We let it. Let's move to the other sentence. We see whether there is such over or under provision. In sentence number 2, we are told, as at 31st of March 2022, the carrying amount of the net asset exceeded the tax base by 1,800 million. This carrying amount does not include the effect of the revaluation in note number 2. The income tax applicable to this company or to this bank is what? Is 30%. Now, that information which are given there is basically to help us to compute something called the deferred tax. The deferred tax. So meaning that in our case here, we don't have any over or basically what? Under provision. So now what you're told from sentence 2 is that the carrying amount of this bank's net asset exceeded the tax base with an amount of 1,800 million. So we said the first thing you need to recall is the name given to this difference. The name given to the difference between carrying amount and tax base. And this is something you also did in financial reporting, and you are told in that topic of income tax, in that topic of deferred tax, you are told any difference between the carrying amount or the difference between carrying amount and tax base of asset liabilities or basically net asset, that one is called temporary difference. Temporary difference is the difference between carrying amount and what? And tax base. And equally, you are told that we have two types of temporary difference. We have the taxable temporary difference. We have the deductible temporary difference. That is something you need to recall. Now, a temporary difference we say is taxable, whereby the carrying amount of the net asset exceeds what? The tax base. And basically, this gives rise to something called the deferred tax liability. So anytime you come across a question and basically you're told a company had a taxable temporary difference, you need to compute the deferred tax liability. Remember, these are taxes to be paid in the future. How do we compute this one? We take the taxable temporary difference, this one, and basically multiply that with what? With the tax rate. Now, on the other hand, a deductible temporary difference that is whereby the carrying amount is less than the tax base. Remember, this should be tax base TB than the tax base. And basically, this give rise to something called the deferred tax asset. How do we compute the deferred tax asset? We take the deductible temporary difference times what? Times the tax rate. So therefore, what we are expected from this, from that point, is for us to determine whether this amount here, which you're seeing is a temporary difference, is it taxable or deductible? In our case, because the carrying amount is more than the tax base, automatically is what? Taxable. So taking into account it is taxable, we will use this to compute something called a deferred tax liability. But still, there is something which you are told in that particular point number 3. I think it should be sentence number 3. We are told this carrying amount which exceeds the tax base with 1,800, this carrying amount does not include the effect of the revaluation in note 2. Remember, once the company revalue assets, that does not affect the tax base. Remember, tax base is the value we use to compute the value of an asset used in taxation. So the value of an asset usually in taxation is always based on the cost. If you revalue an asset, does that affect the value used in computing the carrying amount? Not the carrying amount, sorry, the capital allowances? No. So we compute the capital allowances, which is a allowable expense in tax using the cost. So, but anytime you have revalued an asset, that affects the carrying amount, the value at which an asset is recorded in the balance sheet. So therefore, these particular assets which were revalued upward, definitely that was supposed to increase the carrying amount. But we are told this particular difference which are given here does not include this increase in what? In the carrying amount. That's why we said we will take this particular amount by which the carrying amount exceeded the tax base, and then we have to add this because this one was not captured in computation of this. So therefore, the correct figure for the company's taxable temporary difference will be 18 million plus what? Plus 650. Plus what? 650. And this was giving us 24 what? 50 million. So this is what? This is a taxable temporary difference. So what we need to do is to compute the deferred tax liability. So the deferred tax liability will be equal to the taxable temporary difference times the tax rate. So the taxable temporary difference is this one, 2450 times what? The tax rate, which is 30%. So what will be the deferred tax liability at the end of the year? The deferred tax liability at the end of the year, yes. So that one would be 735 million. Now remember, in preparing the statement of financial position, this is basically what we recognize there, and this is a liability. The deferred tax liability is what? Is a liability. But now there is also something we need to do. We need to prepare a deferred tax account so that we determine the amount of deferred tax to be charged in the income statement. So how do we prepare the deferred tax account? We are going to use certain basically number of items from here and also from the balances we have below paragraph 1. So this is the deferred tax account. The deferred tax account. Now, what do we start by recording here? Remember, whatever you have here, this is the deferred tax at the end of the year. This year ended basically on 31st of March. 31st of March 2022. That is the deferred tax at the end. That's why we are saying that what we are going to recognize as a liability in our balance sheet. Now, when preparing this account, we always start by recording the deferred tax at the start. Now, if you go back to the balances we have below paragraph 1, somewhere in the middle here, we are given the deferred tax at the start. Can you see the deferred tax from those balances we have below paragraph 1? We can be able to see that item of deferred tax. Yes, can you be able to see that deferred tax? The deferred tax? Yes. Deferred tax, somewhere in the middle there. Yes, the deferred tax of 370. And actually, in this case, you can see the question is silent, whether it is a liability, whether it's an asset. If you're given a deferred tax, the question is silent, then we always assume it is a liability. So this one we treat it as what? A deferred tax liability. Being a deferred tax liability, we will record that as the opening balance here on the credit side. Remember, all liabilities have a credit balance. I've said if the question is silent, you assume it is a deferred tax liability. It is a deferred tax what? Liability. Now, after recording that, what else do we record in this particular account? The other item we record in this account is the deferred tax at the end of the year here. Now, this being a deferred tax liability, the balancing figure or the balance carried down should be recorded here. Such that after balancing our account, because this one is a liability, the balance brought down will be a credit balance. Remember, this one is a liability. Yes, but carried down should be on the debit side if it is a deferred tax liability. If it is a deferred tax asset, carried down should be on that side. Now, what else do we record here? The other item which we record here is this item here, 185. We said 185 will be credited in the deferred tax. And that, remember, is the deferred tax on revaluation gain. On revaluation what? Gain, which is basically 185. 185. After recording that, if you can be able to recall what we are doing in a file, the balancing figure in this account should be taken to the income statement. The balancing figure in this what? Account. So if the balancing figure is on this side, that one we take it to the income statement, and this one we refer to it as a deferred tax expense. If the balancing figure is on that side, is a deferred tax expense. If the balancing figure is on this side, still it will be taken to the income statement. That is a deferred tax income. Is a deferred tax what? Income. And I think we will be having a balancing figure on the credit side. So what will be the balancing figure on the credit side? Should be 735. 735 minus 370 minus 195. And basically that will give us an amount of how much? An amount of 170. So what is that? It is a deferred tax expense. Remember, being a deferred tax expense, this one together with the current tax, those two items will be deducted from the profit before tax. So from the profit, or actually once we get the profit before tax, we less the income tax expense. Income tax expense comprises of the current tax and the deferred tax expense. Sasa, yes, I think having that now we can be able to move and basically prepare what is required. Prepare what was required. So actually what the examiner did in relation to this question, he tested the student's knowledge on a number of standards, because what was tested here in relation to this point is the student's knowledge on international accounting standard number 12, income taxes. Here, the examiner was testing the student's knowledge on IFRS 9, financial instrument. We will do something to do with that. We will do something to do with that. And what the examiner was testing here is the student's knowledge on IAS 16. IAS 16, remember, is on what? IAS 16 is on what? Who can be able to remember? International Accounting Standard number 16, from what you did in a FA, what you did in a FAN, is on what? IAS 16. Who can be able to remember? IAS 16. Remember, knowledge on this standard moving forward now is very, very important. Equally nowadays, if, for example, you go to an interview as an accountant, you may be required to mention a number of standards. Because as an accountant, you're expected to have some knowledge on these accounting standards. Yes, it's very, very important. Even if you don't have detailed information about these standards, you need to know. For example, when we talk about IAS 16, it is on what? It is on PP. When we talk about IAS 12, it is on income taxes. So these are some of the questions you're likely to encounter nowadays once you go for interviews. Yes. So let's basically move and start with what is required in part A. And that is basically the income statement of profit or loss. Statement of profit or loss and other comprehensive incomes. Other comprehensive incomes, basically for the year, which ended 31st of March 2022. 31st of March 2022. So here we just need to have a single column and our figures are in million of shillings. So what do we start by recording here? We start by recording the interest income. So we say this format is very, very important. We start by recording what? The interest incomes. The interest incomes by our bank. So if we go back to our question, basically we have a number of interest incomes somewhere in the middle of the balances we have below paragraph 1. So number 1, we have the interest on loans and advances to customers. So this one is an interest income. We said once you go to your bank, you take a loan, you are charged an interest. So the bank is an income. So we just say that this is the interest income from loans and what? And advances. Advances to who? To customers. So no adjustment for that, which is basically 25.75. Then below that, we have interest on government securities, which is an amount of 264. Then we also have interest on deposit with other banks. Deposit or interest on deposit with other banks. So basically that is an amount of 646. And then the interest on deposit from other banks. Interest on deposit from other banks. So remember this basic deposit which is held by our bank here, and those deposits belong to other banks. So our bank here that is better is paying other banks interest. So this one is an interest expense. So then we have the interest on customers deposit is an interest expense. We have interest on long-term borrowing is an interest expense. Yes, and I think those are the only interest incomes which we have. We don't have any other. So let's get the total interest incomes. The total interest incomes. Total interest incomes, we get an amount of how much here? Uh, 54.85 like that. Yes. So and then to this now we proceed and we less the interest expenses. The interest expenses. Interest expenses. Now for the interest expenses, equally we have a number of interest expenses. We start with where we have the interest on deposit from other banks. So the interest on deposit from other banks. Deposit, interest on deposit from other banks. From other banks. So basically that is an amount of 662. We record that here as a negative because we will deduct that from that total. So below that we have interest on customers deposit. On customers deposits, which is basically an amount of 18.33. Then from there we have the interest on long-term borrowing. On long-term borrowing. So that particular interest is an amount of 13.85. But remember, we say that this particular interest on bonds, remember bonds is a form of a long-term borrowing. Anytime a bank issue bonds, that is a form of long-term borrowing. So the interest on this bond basically will have to be included there. That is this interest of 54. We also include it as part of interest on long-term borrowing. So we add 54 there. We add what? 54. And that will give us a total of 19 what? 1939. 1939. After adding the interest on both, are we getting that value? 1939. I've taken the interest on long-term borrowing, 1385, plus this interest on the board. I've said the board is a form of long-term borrowing. Yes. So I think that would basically we have. We don't have any other interest expense. I can't see any other interest expense. I can't see any other. I can't see any other. So what we get here is the net interest incomes, or net interest income. Net interest income. So we take whatever you have here, we less those three interests, those three interest expenses. We less those three interest expenses. What do we get? What do we get, John? What do we get, Timothy here? What do we get, Henley? Charles, what are you getting? 1551. 1551, yes, 1551. So after getting that in net interest income, we said we proceed and we add the non-interest incomes, the non-interest incomes, non-interest income. So the non-interest incomes, these are basically other incomes by the banks other than the interest incomes. And long-term borrowing is not correct. Which figure are you saying is not correct? Is that the figure for 1939? Huh? Oh, okay. Sawa. It should be 14. Okay, sawa. But I hope this one is correct. But I hope 1551 is correct. Okay, sawa. Thank you. So which non-interest incomes do we have? So I think we can get that from where we have below the interest incomes and interest expenses. We have administrative expense, other operating expenses, and then below that we have fees, commission, and foreign exchange incomes. So we have fees, commissions, and forex incomes. So remember, you say these forex exchange incomes. This is basically the profit which the bank, the income the bank gets from buying and selling foreign currencies. We refer to that as foreign exchange income. And I don't think we have any other than that. I can't see any other, including up there. I can't see any other. I can't see any other. So we get the total incomes, and then we less the non-interest expenses. Non-interest expenses. So this will give us a total of 7641. Then next we less the non-interest expenses. Non-interest expenses, I think above this, fees, commission, and foreign exchange incomes, we have two expenses. That is two non-interest expenses. So we have administrative expenses. Administrative expenses, which is an amount of 2160. And then we have other operating expenses. Other operating expenses. And the other operating expenses is basically an amount of 1163. 1163. I can't see any other. I can't see any other, including what we have in the additional information. Yes. So let's get now the profit before tax. We get the profit before tax. The profit before tax. What will be the profit before tax here? 4318. 4318. That is the figure I'm getting. That is the figure I'm getting here. Someone to confirm whether that figure is correct. Okay, sawa. Now to this, we need to less the income tax expense. The income tax expense. So the income tax expense, this comprises of two components of tax. Number one, this comprises of the current tax, which we have here, basically note number 3. Note number 3. So this one, 890. And basically someone may ask, within the balances we have below paragraph 1, there is somewhere we given installment tax paid. I don't know whether you can see that. There is somewhere we given installment tax paid just above the deferred tax. Now, this installment tax paid, generally, I hope you know how companies pay tax. Company pay tax not at the end of the year, but basically a company should estimate the tax to be paid at the start. There is some guideline issued by Revenue Authority on how to estimate the tax to be paid in a certain financial year. That tax has to be paid in 4 installments. In 4 what? Installments. So therefore, like this, the tax for 2022, most of it basically was paid within the current year. Like 3 installments were paid during the current what? The current year. The remaining installment will have to be paid in 2023. So therefore, that installment tax paid will help us in terms of determining how much tax has not been paid at the end of the year. So you can see our company here was supposed to pay a tax of 890 during the current year, because current tax is the tax to be paid in relation to the profit for the current year. In relation to the profit for the current year, this is the tax which is supposed to be paid by the company during the current year. But now, at the end of the year, our company had paid installment taxes amounting to 360 million. Amounting to 360. So the difference here, this is the tax not yet paid. Or in other terms, you can say it is accrued what? It is the accrued tax. Being the accrued tax, this one will be a liability. This one will be what? This one will be a liability. Sasa? Yes. So what I'm saying is that companies do not pay tax once the year comes to an end. So a company should estimate the tax to be paid at the start of the year. And then that tax has to be paid in 4 installments. I hope this is something you know from tax. So that's why I'm saying during the current year, our company was supposed to pay a tax of 890. But when the year was coming to an end, out of this 890, the company had already paid 360. So what we account for here is not the tax which had been paid. Remember, when preparing the income statement, we prepare this on accrual basis. Whatever you capture here is the expense for the current year, not what was paid. The expense for the current year. Our company was supposed to pay 890. That's what we capture here. But when the year was coming to an end, the company had already paid 360. So the balance, which is around 530, is the current liabilities, what had not been paid. That will be paid in 2023. We will account for that as a liability. That's yes, but basically what we account for here is the tax for the year. I hope that point is clear. I hope that point is clear. Now having that, we can proceed, and basically we also account for the deferred tax, because I say that this income tax comprises of the current tax and what? And the deferred tax expense. The deferred tax expense is what we computed here, this particular amount here, the amount of 170. The amount of 170. So that is basically what we captured here. And then we get what? We get the profit after tax. The profit after tax. So how much will be the profit after tax? The profit after tax. $32.58, yes. So after getting that, we proceed, and basically we add other comprehensive incomes. Other comprehensive incomes. So remember, other comprehensive incomes, these are the other incomes which should not be part of this profit. They should be added to the profit after tax. Yes. So, and I think in our case, we only have one item, this revaluation gain But we said we will record it here, we will recognize it here net of deferred tax. And I think we computed that amount to be recognized here, and it is that amount. So we have the revaluation gain on property, plant, and equipment, which was basically 650, but we deducted the deferred tax. So this one, therefore, will be recognized here net of deferred tax, 455. So we don't have anything else. We get the total comprehensive what? Income. Total comprehensive incomes here will be 3. 1. We should get 7. That is 7, 13. That is 7 what? 13. That is 7, 13. Yes. So that is it. That basically what is required as far as that question is what is concerned. Now, because of our Muslim brothers, I want to give you a short break of just 10 minutes. We come back and then we finish on what is remaining. We just take a short break of 10 minutes. We come back and then we prepare the statement of financial position. Sasa? Yes. So we take that short break. Yes. So I want us to continue. I hope you're back. Let's continue. Let's continue. Are you back? Are you back? Are you back? Are you back? Please confirm whether you are back. Okay, sawa. So let's finish. Basically by preparing what is required in part B. So in part B, we are required to prepare the statement of financial position. So this one basically we record assets, liabilities, equity of the bank, and always we start by recording the asset here. So this will be our part B, our statement of financial position. And basically this is at 31st of March 2022. 31st of March 2022. Yes, so we start by recording assets. And remember, in this case, we said when recording assets of a bank, we don't classify them. So the rule is that we should record these particular assets in the liquidity order. We start with those assets which are either liquid or highly liquid. And finally, we record those assets which are least liquid. They cannot be converted into cash within a short period of time. So that is basically the rule here. Yes. So which are the asset or which asset do we start with? I think we will basically start with the first item given below paragraph 1, and that is the cash and balances with central bank. Cash and balances with the central bank, which is basically 46. So then from there we have money on demand, and the short-term deposits, and short-term deposits, which is basically 21 what? 50. Remember, you say that this is basically the amount of cash which is held by the bank to meet the customer's deposit. If you go to your bank, you want to withdraw some cash, the bank basically uses this to meet your withdrawal demand. So it's basically a cash. So then below that, we have deposit with other commercial banks. We have deposits with other commercial banks. Basically, that as an amount is an amount of 46, an amount of 46, an amount of 46. Because of space, we have to do away with this one. Yes, so then below that we have deposits from other commercial banks. Deposit from other commercial banks, this one is a liability, that's what we know. Then from there we have investment in government securities is an asset. Investment in government securities. Which is basically an asset, 4485. Then from there, we have investment in equity instrument. So this is basically investment in shares, which is still an asset. Equity instrument, which is an amount of 765. So then from there, we have property, plant, and equipment. Property, plant, and equipment. But this one will have to be adjusted as per note number 2. So we will take the amount of 7416, and then to this we add the revaluation gain. So the revaluation gain. So the revaluation gain basically is this amount. So we are not adding that here net of deferred tax, because you can see that deferred tax of 185, there is nowhere it is affecting PPE. So it's only supposed to reduce the amount to be taken to the revaluation reserve account, but it's not affecting this. So we add 650 there. So that will give us a final value of what? A final value of 80 what? 8066. Yes, 8066, like that. So below PP, we have intangible assets. Any adjustment for that? None. So we have intangible assets. Intangible assets 4986. No adjustments. So then from there we have loans and advances to customers. To the bank, this one is basically an asset. The loans which are given to customers, loans and advances to customers. That one is basically an asset. So then from there we have customers deposit. Customers deposit to the bank. This one is a liability. Then we have long-term borrowing is a liability. Below that we have other receivables, which is still an asset. Other receivables. So other receivables is an amount of 2493. Then we have other payables is a liability, installment tax. That is not an asset. Okay, down there I can see what ordinary share capital deposit. Yes, we don't have any other item of assets. What about the additional information? We have dealt with note 1 will not affect asset. Note 2, we have made adjustment for that, equal note 3. So I think in our case, we are done with the assets. So let's get the total assets. Let's get the total assets. I'm told by Naitari will be 39. 39. What? 735. 735. Someone to confirm whether that is the value you're getting. Confirm whether that is the value you're getting. Is that what you're getting is the total assets? Yes, confirmed by Charles. So from there, we double underline that, and basically we move and we record equity. Equity, which is basically share capital and reserves. So we will start with the ordinary share capital. Ordinary share capital is just downstairs below interest incomes, below interest expenses. We have ordinary share capital. Basically, no adjustment for this. That is an amount of 44. So below that, we have share premium, equally no adjustments. Share premium, which is an amount of 25. Then we have the deposit protection reserve. Deposit protection reserve. Reserve, equally this one will not change because there was no any amount which was transferred to that reserve, which is basically 5,000. Then from there we have the retained earnings. The retained earnings. So the retained earnings, this one, we take the retained earnings given fair, which is basically an amount of 36.23. So to remember to this, we need to add the profit for the current year. Which profit do we add here? We basically add this profit after tax, not the other comprehensive incomes, but basically we add the profit after tax. The profit after tax is 32.58, this one. Yes. Now, there are some questions you may come across whereby equally you're given some dividends which were paid to the shareholders, not the proposed dividends, but dividends which were paid. In case you come across a question whereby there are some dividends which were paid, the dividends we know are paid from the profit. So those dividends which were paid, let them fair. But in our case, we don't have dividends which were which were paid. So what will be the net amount? The net amount there, 36.23 plus 32.58. I'm given what? I'm given 68.81. 68.81. Yes. So that is what we have. And then below that, we have suspense. Remember, suspense, we were told as per note number 1, basically related to this board there. That suspense of 414, because we were told what our company had accounted for. Our company had accounted for this 450 and this particular amount of 36. And I think I'd explained how we had computed. This amount was arrived. It was 450 minus 36. So, but basically we said what the company or what you're going to account for here is the amortized cost which we computed here. And I think with the interest which we computed here as an expense. Yes. Now, do we have any other component of equity here? Yes. Recall, this bank revalued some items of PPE. There was a revaluation gain of this, but we said that one we recognize it here, net of the deferred tax. Net of the deferred tax. So we will have a revaluation reserve. The revaluation reserve, which is basically this one minus deferred tax. Minus the deferred tax. So 650, we minus the deferred tax of 185. So whatever you recognize here has to be net of deferred tax. That is 455. It has to be net of the deferred what? Tax. It must be net of that deferred tax. It has to be net. Do we have any other component of equity? I can't see any other. So let's get the total equity. Let's get the total equity. The total equity. So actually, this was a very, very good question. A very, very good question because it tested so many concepts. It was a very good question here. 19 to 36. 19 to 36, like that. Yes. So then from there, we basically move and we record what? We record liabilities. Now, for liabilities equally, recall, we don't classify the liabilities into non-current and current. Yes, we don't classify the liabilities. So where do we have liabilities? So liabilities, I think we can start up there from where we have deposit from other commercial banks. Deposit from other commercial banks. Deposit from other commercial banks. This one is basically a liability from other commercial banks. That is 324. So then we have investment property, intangible, loans and advances. And then from there we have customers' deposits. Customers' deposit, this one is equally a liability. Once you have some deposit with your bank, to you it is an asset, to your bank it is a liability. So the customer's deposit is 70.65. 70.65. So then from there we have long-term borrowing. Long-term borrowing. Now this long-term borrowing equally, we have to adjust that with this both, because this both I said is a form of a long-term liability. Is a form of a long-term borrowing. So we will take the long-term borrowing which are given there, which is an amount of how much? An amount of 5660. And then we add the amortized cost. The amortized cost of the board. The amortized cost of the board is this one, 468. 468. So that will give us a total long-term borrowing of how much? The total long-term borrowing. Total long-term borrowing. You're getting what? Yes, that one should be Henry. Is that correct? 6128. 6128. Yes. So we have that. Then we have other receivables below long-term borrowing, and then we have other payables. Other payables. So other payables is an amount of 2717. So then below that we have installment tax, and basically we said that that particular installment tax will be used in terms of computing how much tax had not been paid at the end of the year. So remember, this company we know, as per the information we have in note number 3, our company was supposed to pay a tax of 890 million. This is the tax which was supposed to be paid in 2022. But our company had paid installment taxes amounting to 360. So the difference is what had not been paid. We can just refer to that as the current tax payable. The current tax payable, 890 minus what the company had paid. Minus what our company had paid. So the difference is what had not been paid, which is 530. Is it 530? Yes, 530. So then from there, below the installment tax, we have the deferred tax. Remember, the deferred tax which we recognize here as a liability, the deferred tax which we recognize here should be the deferred tax liability at the end of the year. So how much is the deferred tax liability at the end of the year? Is what we computed here. This is the deferred tax liability at the end. Basically, that is what we recognize here as a liability, not at the start, not this one, and not that one. The deferred tax liability at the end. So 735. So what else do we have here? I can't see any other item which you have not captured below as per the information you have below paragraph 1. What about in the additional information? Note 1, we have dealt with these boards. Note 2 and note 3. I think we are done. I think
Starter class is to ensure we are recording. So now we have missed something, but no problem. So we are saying, so maybe just a recap. So we have said time value of money, it is that the fact that over time, the value of money changes. The value of money does not remain the same. And I'm saying, assuming here, now, that is year 0 today, and we have 10 years to come. 10 years to come. So we have 1 million shillings today here. Shillings 1 million. And here we have shillings 1 million. So we're saying the value of 1 million shillings today. This, it's like, if you remember what I said, assuming someone tells you that I give you 1 million shillings today, or you wait, I give you 2 million shillings after 10 years. I either give you 1 million shillings today, or you can wait, I give you 2 million shillings after 10 years. which one is better? And we said holding other factors constant, because there are other factors that can influence your decision. Maybe you are going through a difficult time and you don't care what you're going to get after 10 years, but holding other factors constant, just look at the 1 million now and the 2 million after 10 years. You said you would rather go for the 1 million because this it may be if you determine what is the present value of 2 million shillings expected in future, because remember, this 1 million is in present value terms. This one is in present value. Present value means now. But this 2 million is in future value. This one is in future value. If an amount was be received in future, we say it is in future value form. If it's been received or paid today, we say it's in present value terms. So before you make your decision on whether to go for the 1 million or the 2 million, you're supposed to ascertain what is this 2 million in present value terms, because I'm being promised the 2 million in future value terms. But what is the present value of this 2 million in present value terms? That is, you bring it to present value terms. See, tumeanza kurecord. Oh, okay, yeah. So that was earlier. So what is this in present value terms? So when you ascertain the present value of these 2 million, that is bringing it in present value form, you may realize that it is 0.8 million. So if it is 0.8 million, you will say, I would rather go for the 1 million shillings today. Yeah, are we together? You would rather go for the 1 million shillings today, but you cannot compare 1 million and 2 million. Those two figures are not comparable because one is in present value terms, the other one is in future value terms. You cannot compare an amount in present value terms with an amount in future value terms. If you want to have a fair comparison, or if you want to form an even ground for comparison, you must either take this 1 million to future value or bring this 2 million to present value. And the most important thing, it is bringing, okay, either way can work. So, but you must compare the two amounts in same form, either in present value terms or in future value terms. And that is where now the concept of time value of money comes in, determining either the future value of an amount or the present value of an amount. Now, let's say something now about the time value of money. So time value of money, we've said here we have present value, and future value. So present value, we have that direction, and we have this direction. So this is to say, you can work from present value terms to future value, or you can work from future value to present value. When present value to future value, when we are doing present value to future value, we call it compounding. This one you must have done in mathematics, compounding. Compounding, it is determination of a future value from a present value. Determination of a future value from a present value. For example, in our example here, you have been given 1 million. You want to know, if I get this 1 million today, I'm going to invest. Remember, you're not just getting the 1 million and keeping it maybe under the bed. No, you'll get the 1 million and invest somewhere. If you invest, it will earn a return. So after 10 years, you will not just have 1 million, but you'll have 1 million plus a return. So we want to know this 1 million plus the return that you're going to earn, how much will it be after 10 years? That is determining the future value from a present value. And that is what we call in compounding. That is compounding. The other one, we are moving from future value to present. Like in this case, you're being given 2 million shillings after 10 years. But you want to know what is the worth? What is the worth of 2 million shillings 10 years to come? What is the present value of this amount? So you go backwards. Working from future value to present value, we call it discounting. Discounting. This is discounting. Discounting is determination of a present value from a future value. Determination of a present value from a future value. And I've said, when you are given an amount in present value terms and another amount in future value terms, and you're supposed to compare the two, you cannot compare when they are not in the same form. You're supposed either to convert them to present value or to future value and make a decision or make a conclusion. That is all about time value of money. So let's see what we have in the handout. There is a handout I've just shared. There is a handout I've just shared in the WhatsApp group. Kindly check. Kindly check. Have you seen that handout? I shared just a few minutes before the class. I want us to look at it. In case you have a question, you can ask before we proceed. In case you have a question, kindly ask. Okay, fine. Let's. I want to believe you've seen the handout. It's important to respond. Kindly respond if you've seen the handout. Okay, fine. Let's continue. Thank you, Alice and Akin, Alan as well. So up there, you can see the introduction, concepts of time value of money, introduction. A shilling today is worth more than a shilling tomorrow. All what I've explained is what you can find there. Future value techniques. Future value techniques, you can see there we have future value. That is what I've explained. An amount that will be paid or received in future, we call it a future value. Then we have present value techniques. Present value, I've said, is an amount today. As an amount today, present value. Compounding techniques, but I'm not saying you are going to make sure you go through this, the theory part, at your own free time. But this is what I've just summarized. There is no need of repeating. I just want us to walk through. Compounding techniques. Compounding techniques, we've said, okay, this is what we did in mathematics. Simple interest and compound interest. So again, that is not important, so much important. I just want us to look at the, but let's, yeah, we are under compounding techniques. Here we've talked about two concepts, the concept of compounding, the concept of discounting. So I want us to start with compounding. That is compounding techniques. That's the reason why there they are saying compounding techniques. Compounding techniques. So we start with the compounding techniques, number one. Determination of a future value from a present value. Compounding techniques. Compounding techniques. Now, we start with future value of a lump sum. Okay, in here, we will not focus too much on the illustrations that we have there in the handout. I want you to make short notes. I want you to make short notes as we continue. I have some handwritten notes here that I want to share with you. So just write concepts of compounding. Concepts of compounding. concepts of compounding or compounding techniques, and we start with the first one, future value of a lump sum. 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 Alan? Okay, I will share. But the handout is more summarized. So we start with future value of a lump sum. Now, when you talk about, the most important thing here to understand is what is a lump sum? What is a lump sum? A lump sum, this is an amount that is received or paid once. An amount that is received or paid once is what we call a lump sum. For example, let's say if you pay or receive 2 million shillings today, that is a lump sum. Or if you invest, let me show you. Let's first understand. We have two things here. We have a lump sum. We have a lump sum. And we have an annuity. And an annuity. So here, let's say we have periods. We have period 1, 2, 3, 4. So we have amounts. Let's start with lump sums. Lump sum amounts. Lump sum. Let's say in year 1, the amount is 300,000. In year 2, it's 550,000, 600,000, and 700,000. These are what we call, all these are lump sums. Okay, let's have annuities. Annuity amounts. These are like installments. They are equal 400,000, 400,000, 400,000, 400,000. So annuities, they are equal amounts received or paid regularly. Equal amounts received or paid regularly. And we say, when we say regularly, we are saying it's either monthly, weekly, semi-annually, yearly, quarterly. That means like every month you are paying or receiving 400,000. That is an annuity. Or each year you are paying or receiving 400,000. That is an annuity. Equal amounts received or paid regularly. Lump sum amounts. Lump sum amounts, you're saying this is an amount which is received or paid once. They do not repeat themselves. For example, in year 1, you'll receive 300,000. In year 2, you're getting 550 or paying or 550. Year 3, 600. Year 4, 700. Maybe let's say year 5, 300,000. You cannot say that since 300,000 is appearing twice, that it is an annuity. No, it is not an annuity because it has not been received regularly. You've received 300,000 after some other cash flows have been received here. Are we together? So all these are lump sums. All these are lump sums. However, if you get 300,000 here and 300,000 here, we have two 300,000s that follow each other. This one and this one. This one will be referred to as an annuity. This is an annuity. Year 1 and year 2, or period 1 and period 2, we have an annuity of 300,000 because they follow each other. Yeah? But if the 300,000 occurs after, let's say, for example, here we have 700,000 and here we have 300,000. So in year 1 and year 3, we have 300,000. These are not annuities, they are lump sums because in between them, there is a figure that is different from them. I want to believe that is very clear. That is clear. a lump sum and an annuity. This is a concept that we are going to use a lot in financial management, and that is why I want you to be able to differentiate lump sums and annuities. Again, so this was 6. Let's say this was what? This was 500. Let's say now, yeah, 300,000 there. 300, yeah, let's say 300,000 here. So in year 4 and year 5, the 300,000 becomes an annuity because they follow each other. We have two 300,000s that follow one another. So they are annuities. So I want to believe that is clear. That's okay? Okay, fine, let's proceed. So we now looking at future value of a lump sum, future value of this kind of cash flows, future value of this kind of cash flows. So when you want to determine the future value of a lump sum, future value of a lump sum, future FV, its future value of a lump sum is equals to present value, or let's say principal, what you are used to, principal times 1 plus r power n. Principal times 1 plus r power n. And this is what you call present value. Present value. This principal figure here is what we call present value. Let's see what we have in the handout there. Check what we have there. Where are we? Where are we? Future value of a future value of a lump sum should be there. If you look at the handout, you'll see using tables to find future. No. Equation for finding future values of a single amount is derived as follows. How it is derived is not so much important to us. The most important thing is this. Yeah, this is how we get the future value of a lump sum. Future value of a lump sum is equals to principal into brackets present value times 1 plus r power n. This factor here, this factor 1 plus r power n is called what? Future value is called future value interest factor. This one is called future value interest factor. Future value interest factor. That factor is called future value interest factor. This one is very important. 1 plus r into bracket power n. So here we can say where FV is future value, R is the discounting, or not discounting rate, but rate of return. It's important for you to write this formula. Just write this, just write that. Rate of return is like the interest rate. Rate of return is like the interest rate. Yeah. Do we have an example there? So the example, yeah, there should be an example somewhere. Yeah, there is an example there. Look at that example. They're saying, assume that you've just invested Kenya shillings 100,000. The investment is expected to earn interest at a rate of 20% compounded annually. Determine the future value of the investment after 3 years. So, okay. Let's look at that. We are doing that illustration, that example. We're saying, assume that you have invested shillings 100,000. That is the present value. That is the principal. The principal amount, which is present value amount, is Kenya shillings 100,000. 100,000. Then the investment is expected to earn interest at the rate of R is 20% per annum. This per annum is very important. Okay, it is not given. They have not said per annum, but we say when you get a rate of return where the period, whether the per annum, per month, semi-annually is not stated, the standard measure is per annum. So unless it is specified like semi-annually or what, you should take it as per annum rate. So per annum is 20%, compounded annually. Determine the future value of the investment after 3 years. N, we should have said N here. N is equals to number of periods. Number of periods. Kindly have that. Number of periods. Number of periods. Make sure you write that. So here, our period is 3 years. We are investing for 3 years. So future value we are saying is equals to present value 1 plus R power N. So future value is equals to 100,000 times 1 plus 0.2 power 3. Power 3. So get the value of the investment after 3 years. Value of the investment after 3 years is how much are you getting? There are people, no, but you must be knowing how to put this power 3 in calculators. Anyone who doesn't know, you will be assisted. Now, for example, we have two answers here. We have 172,800 and we have 106,120. Alice, I'm doubting your answer. At a rate of 20%, even in the first year, we are going to earn 20,000. Because first year one, we will say 20% times this. Times 100,000, that is 20. That means it's more than 106,000. So 178, probably 172,800. 172,800. Alice, repeat your calculation. Okay, yeah, 172,800. That is what you're supposed to do. Another method of getting this. Another method of getting this is OR. So here you say OR, a very long method. You'll say period here, period 1, 2, and 3. Amount, let's say 100,000. No, will that give us? No. That is the only way. Okay, the other method is where we say, but this one is very long. Where you say here it's 1 plus 0.2. The figure that you'll get here, you bring it here. Then you continue. But that will not apply in this case because we are only investing 1. So you can continue. You grow by that rate. So just stick to this. Just stick to this. Any question before you continue? We want to proceed. Okay, number 2, future value of an annuity. Future value of an annuity. Future value of an annuity. Future value of an annuity, and you have seen how we get the future. I've explained what's an annuity. Future value of annuity. Future value of annuity. Now, a future value of an annuity, just like we've said, you get the annuity. It's an annuity when the amount occurs repetitively, but regularly. So future value of an annuity is computed as follows. Without wasting a lot of time, future value of annuity is equals to the annuity. You get the annuity amount times annuity amount times. So we have the future value annuity factor. The future value annuity factor, you say 1 plus R power n minus 1 over R. That's how we get the future value of an annuity. 1 plus R, and write these formulas because the way they are in the handout. Okay, they are very much simplified in the handout. Just write what I'm writing on the board. Yeah, it's there, but write. Future value of an annuity is equals to annuity times 1 plus R into brackets power n minus 1 over R. This factor here, the factor 1 plus R power n minus 1 over R is called future value interest factor of an annuity. Future value interest factor of an annuity. What have they said there? Future value interest factor of an annuity. Future value interest factor of an annuity. This one. Now, we have tables. We have tables where these factors can be read from. Like, you remember what table do we have? We have math table. Do you people know what's a math table? Or maybe what we call what? Normal curve, normal distribution curve. We have tables. We have tables where you can read these factors. When we go to discounting, I'm going to share the tables so that we can see. But for future values, the tables for compounding, it's not widely used in financial management. So just get these formulas right. Yeah. So any question here? There is nothing to explain. We know R is the rate of return or the interest rate. N, it's the number of periods. So there is nothing to explain. Let's go to what? Let's have an illustration. Do we have an illustration there? From the above example, there is a statement that says no. We have an example. What is the value of shillings 100,000 investment annually at the beginning of each of the next 5 years at an interest of 12%? Are you there? Have you seen that example? And finding future value of an annuity. Oh, that's due. Sorry. What is the value of 100,000 investment annually at the beginning? That's an annuity due. We are coming to that. I want us to have an illustration on the illustration on future value of an annuity. Okay, let's say from the above example, there is a part that is missing here. There is a part that is missing. But all in all, let's just write an example there. Just write something, just write an example, an illustration, say an investor intends to invest shilling 60,000 at the end of each year for 4 years. An investor intends to invest shilling 60,000 at the end of each year for 4 years. At the end of each year for 4 years. Full stop and say, the investment will earn interest. The investment will earn interest at a rate of 20%. The investment will earn interest at a rate of 20%, compounded annually. The investment will earn interest at a rate of 20%, compounded annually. Compounded annually. Full stop. Determine the future value. Determine the future value of the investment. Determine the future value of the investment after 4 years. Determine the future value of the investment after 4 years. Determine the future value of the investment after 4 years. After 4 years. Now, future value of the investment. Now we start. This is how you should be approaching these questions. You first analyze the question. For example, here we are saying amount to invest is 60,000 at the end of each year. So annuity. We say annuity. Shillings 60,000. Annuity shilling 60,000 at the end of each year for 4 years. Period is 4 years. 4 years. Then the investment will earn interest at a rate of 20%. So 20% per annum. So we want the value of the investment after 4 years. So future value of annuity is equals to the annuity times 1 plus r power n minus 1 over r. So here you say 60,000 times 1 plus 0.2 power 4 power 4 minus 1 over 0.2. So get the value of the investment after 4 years. Then I show you another way of doing it. Get the answer, get the answer. Get the answer. $322,080. $322,080. Another person. $322,080. Another person. Alice, okay, that's fine. Now, there is another way of doing this question. So this is now, you say period. Period. 1, 2, 3, 4. annuity or amount. Remember, this person is investing 60,000 at the end. Yeah, at the end of each period. 60. 60. 60. 60. At the end of each period, this person is investing 60. So here you say 1 plus R power n. If we want to treat each amount as a lump sum, then here we will have future value. Future value. So here we will have 1 plus R. 1 plus R. This is 0.2. 0.2. 1 plus 0.2. 1 plus 0.2. 1 plus 0.2. 0.2. 1 plus 0.2. So before that, we know we've not put n. That is what I want to illustrate here. That is what I want to illustrate here. So we are 0. We always start at 0. 0 means now 1, 2, 3, 4. We're talking about 4 years, which is 1, 2, 3, 4. So here we have at the end. We are investing at the end. So at the end of the first year, 0, 60, 60, 60, 60. I want us to put n. So this 60 that you've invested at the end of year 1, how many times will it earn interest? The 60 that you invested at the end of year 1, how many times will it have earned interest at the end of year 4? It is here. 1, 2, 3. We have invested 60 here, so it will earn a return here, a return here, and a return here. So you say power 3. That is power 3. Then the other 60 at the end of year 2 here, it will earn interest here and here. So you say power 2. The 60 that you invest at the end of year 3, it will earn interest once. So you say power 1. And the last one, the 60 that you are investing at the end of year 4, it will have earned no return. So you say power 0. So multiply and get the total. If you multiply and get the total, we should be getting the same answer as this. We should be getting the same answer as this. So the reason why I just want you to get the concept, the concept here of power what, power what, power what. So 103,680 must be the first one. 103,680. 103,680. 86,400. 72,000 and 60,000. So get the total. Get the total. $322,088. Yeah. So almost the same as what we have here, just because of rounding off. That's where there are differences. So is that okay? Let's proceed. Let's do the next one, then we go for a break. The other one is Future value of an annuity due. Future value of an annuity due. Let's wrap this. Future value of an annuity due. Now, what we have talked about here, it is an annuity that occurs at the end of the period. So here we had 60. If an annuity occurs at the end of the period, like in this case, that is what we've done in part B. But now we have what we call, okay, fine, Alice, 080, okay, fine. So, future value of an annuity, this is when the amount is invested or paid at the beginning of the year, at the beginning of the year. For example, if our 60 here, 0, 1, 2, 3, 4. If the investment is done at the beginning of the year, for example, here 60, 60, 60, 60, 60, we call it 1, 2, 3, 4. This is not there. We call it an annuity due. So an annuity due is an amount that is invested or paid at the beginning of the period. And this will change because now, like here we had said this is power 3 because we counted here 1, 2, and 3. But if it's an annuity due, we will now have 1, 2, 3, 4 because we are going up to the end of year 4. Because we are going up to the end of year 4. So the amount that we invested at the beginning of year 1 here will earn interest 4 times. 1, 2, 3, 4. The amount that you invested at the end of year 1 will earn interest 1, 2, 3. This will earn 1, 2, and this will earn 1. So the entire thing will change there. But now, how about when we are using the formula? When we are using the formula, this is how we get the future value of an annuity due. So here we say future value of annuity due is equals to annuity times 1 plus r power n minus 1 over r. Then we add another factor here, 1 plus r. 1 plus r. 1 plus r. 1 plus r power n minus 1 over r times 1 plus r. So this is now what caters for the element of investing at the beginning of the period. So you can write that. And then we have an illustration. So back to the handout, there is an illustration. Finding value of an annuity due. We have an illustration for that. If you can check in the handout, they're saying, assuming the above example, the investment is made at the beginning of the year rather than at the end. So example, what is the value of shillings 100,000 investment annually at the beginning of each of the next 5 years at an interest rate of 12%? So let's do that. So we're saying, what is the value of shillings 100,000? So annuity, the annuity is 100,000. What is the value of shillings 100,000 investment annually at the beginning of each of the next 5 years? The period is 5 years. Interest is 12% per annum, and it's at the beginning. So future value of annuity due is equals to the annuity. And you need to be writing these formulas every now and then. Every time you're doing a question, kindly write the formula. Even if you know the formula, just write it. So annuity times 1 plus r power n minus 1 over r times 1 plus r. So annuity is 100,000 times 1 plus 0.12 power 5 minus 1 over 0.12, then times 1 plus 0.12. So get the value. Then you are going to use this method to see. So how much are you getting? 711,518.9. 711,518.9. Now, using this method, we will have this. We will have here 0 here. 1, 2, 3, 4, 5. And remember, the reason why we are starting at 0, you must count 12. Oh, someone else is getting 424, eh? 711, 424. Okay. Another person? A third person? Okay, let's continue as we wait. So, 513, 518, around that range. Now, so I'm saying we start at 0 because we must count 518. Eh? Okay, fine. Let's go with 518. We must count 12 months before we call it a year. So we are saying we are investing 100,000 at the beginning of each year. 100,000, 100,000, 100,000, 100,000. Remember, the end of year 1 is the beginning of year 2. So this 100,000 here we are investing at the beginning of year 2, which is the end of year 1. So we are saying this first 100,000 that was invested at the beginning of year 1, how many times will it earn interest in a period of 5 years? 1, 2, 3, 4, 5. So you say power 5. The other one is power 4, power 3, power 2, and power 1. The last one that we are investing at the beginning of year 5, it will also earn interest during year 5. So at the end of year 5, it will have earned once. That is why we are saying power 1. If you do the future value here, you're supposed to get almost the same answer as what you're getting here. So just check whether you're getting the same. On 76 to 34 point you can, okay, in this case you can round off. In this case you can round off to whole numbers. You can round off to whole numbers. In this case, there are situations whereby the decimal points will be required. So let's round off to whole numbers. The first one then should be 176 to 34, 157, 352, 157, 352, 140, 493, 140, 493, 125 for 40, 125 for 40, and 112,000. So get the sum. $711,519. 711,519. Now the reason why we are doing these two methods, this is very short. This is like a shortcut, but we are doing this method so that you can get the concept, because there are questions that will tell you that the amounts were invested at the beginning, the amounts were invested at the end of the period, this and this was happening. So this one is very important. Kindly get the concept. Then after the break, we will look at discounting techniques. Discounting techniques. After the break, discounting techniques. Discounting techniques. So let's have a break of like 5 minutes. And as we've said, discounting is this determination of present value from a future amount. Determination of present value from a future amount is what we call discounting, or rather, yeah, discounting. So we start with the first one. Present value of a lump sum. Present value of a lump sum. Present value of a lump sum is the first one. A lump sum, still the same thing as we've said, an amount that is paid or received once is what we call a lump sum. So